The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled, America for Sale, an examination of the practices of private funds. I now recognize myself for 4 minutes to give an opening statement. Today, this committee convenes for a hearing to examine the impact of private funds on businesses and workers. While there are some examples of private equity firms playing a beneficial role in the U.S. economy, there are far too many examples of private equity firms destroying companies, preying on hardworking Americans to maximize their profits. Today, we're going to take a hard look at those practices and examine whether Congress should take action to prevent the drastic increase from the $250 million it spent in 2009 on those industries. A New York Times investigation found that an ambulance company One moment, please. We missed a page. After the devastation of the foreclosure crisis in which millions of people lost their homes through no fault of their own, private equity firms swooped in and purchased hundreds of thousands of foreclosed homes at discounted prices. In many cases, they converted these homes to rentals, charged excessively high rents, and became absentee landlords without community ties. Private equity firms increasingly hold ownership of hospitals, nursing homes, and emergency services. In 2018 alone, private equity firms spent a total of $10.4 billion buying up hospitals and medical clinics, a drastic increase from the $250 million it spent in 2009 on those industries. A New York Times investigation found that an ambulance company owned by private equity, Rural Metro, had slower response times under private equity ownership and undertook, quote, more aggressive billing practices, end quote. According to the report, quote, Rural Metro once spent a 761 collection notices to an infant girl born in an ambulance, end quote. In the retail industry, 10 of the last 14 companies that have declared bankruptcy were owned by private equity firms. For example, Toys R Us was acquired by private equity firms and a real estate investment trust in 2005. By 2018, Toys R Us had declared bankruptcy, laid off all 30,000 of its employees, and closed all of its stores. Meanwhile, the company's private equity owners had pocketed $470 million in fees and interest payments from the company. Today, we will hear testimony from Ms. Giovanna De La Rosa, a former Toys R Us employee and advocate. These are just a few examples of harm that private equity firms have caused. Unfortunately, the private equity firms the committee invited to testify at this hearing today declined to send representatives to engage and answer questions about their activities. So I would like to thank Drew Maloney, President and CEO of the American Investment Council, which is a trade group that represents private equity firms, for joining us today and testifying on behalf of the industry. But while he will testify on private equity as an industry, Mr. Maloney will not be able to adequately speak to the practices or activities of certain or specific firms. And so while we will get started with this today, we're going to have to determine what other actions we may take in order to get the information that we think we need in order to make some determination about what exactly is going on in our society with private equity firms. And so I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes for an opening statement.
Well, I thank the chairwoman for holding this hearing today, and we'll all My Democrat colleagues are not just only down the hall attempting to undo the 2016 election. It appears today that committee Democrats are working to predetermine the 2020 Democrat nomination for their party. Today's hearing is devoted to H.R. 3848, the House companion to Senator Elizabeth Warren's bill and a key tenet of her presidential platform. Hooray, we're here today to debate presidential politics. Moreover, one of our witnesses testifying here today is cited in Senator Warren's press release from her presidential campaign as providing the economic analysis, in quotes, I would say, of the bill and its impact. This bad bill strikes at the foundation of American capitalism. I know there's a socialist lane in the Democrat primary for president. This clearly is that fight for that socialist lane. It has harmful effects as well. A recent, more detailed analysis of the bill found in a modest case scenario, the low range, this bad bill would reduce the American workforce by 6 million jobs and lead to $109 billion per year in lower tax revenue. That's the tax revenue piece only. To repeat, that is a conservative estimate. In fact, the worst case scenario says that over 26 million jobs could be lost. To sum up, the Warren bill, this bad bill, if enacted, would be a disaster for American workers. Congress should be focused on policies that make the economy more free, open opportunities, make the capital markets more attractive and more competitive against our competitors around the globe, rather than bills that add regulatory cost and harm our markets and hurt jobs. Good policies, such as the bipartisan bills we passed last Congress, could lead to greater opportunity and choices for everyday investors to grow their savings. Instead, this committee wants to use full committee hearing time to go after and vilify one industry. There will likely be several misconceptions presented today by my Democrat friends, so I want to use some of my time here to address those. First, private equity is not just about large investors buying out large companies. Generally speaking, private equity is a variety of private investment, from venture capital to capital injections for small businesses to lending so that small businesses could buy mismanaged other businesses that have potential, huge potential, if just managed correctly. Second, private equity's business model does not involve intentionally bankrupting companies. Bankruptcy is failure. Failure is not a part of the business model. Success is. That's where you see the job growth. That's where you see the returns. And so the idea that a industry could benefit by failing doesn't make sense. Third, a misconception that some will present is that private equity is just about Wall Street. It's not. Private equity creates investment opportunities that lead to jobs. According to a recent Ernst & Young study of the impact of private equity in the U.S. last year, private equity supports at least 100,000 jobs in 27 states and over 10,000 jobs in each state. Additionally, everyday Americans directly benefit through pensions. U.S. pension funds invest about 9% of their portfolios in private equity, and that same study found that private equity has outperformed investment in public equity, fixed income, real estate over the last decade. That means that everyday investors, including folks from teachers and firefighters and police, all benefit. But don't take my word for it. The chief investment officer of CalPERS recently said the following: "We need private equity to be successful, we need more of it, and we need it sooner rather than later." With that said, I do want to note private equity has become more important in the American economy, due in no small part to increase regulatory barriers on public companies. We should remedy that public company piece, not have a presidential rally for Senator Warren.
I now recognize the ranking member of the committee, the gentleman from North Carolina. Oh, already spoken. I now recognize the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, Ms. Maloney, for 1 minute.
Thank you, Madam Chair. Many private equity funds have caused needless suffering for ordinary workers, especially in the retail sector. All too often, when a private equity fund buys a company, they pile an excessive amount of debt onto the company and then use the bankruptcy system to slash pensions and benefits for ordinary workers. While not all private equity funds are created equal, it's clear that our committee needs to closely examine these practices. I am also pleased that this hearing will examine the Stop Wall Street Looting Act, which has been introduced in the House by Mr. Pocan and Ms. Jayapal. This bill would require private equity funds to share the liability for the debt that they pile onto their portfolio companies. I believe there's a good cause to be made for increased risk sharing between private equity funds and portfolio companies in order to deter the heads I win, tails you lose mentality. Thank you, and I yield back, and thank you for having this important hearing.
I now recognize the ranking member of subcommittee, the gentleman from Michigan, Ms. Hazinga, for 1 minute for opening statement.
Private equity is an important aspect of the U.S. capital markets that helps create jobs and bolster pension returns for Main Street Americans. Most PE firms make long-term investments in companies poised for growth, as well as undervalued or underperforming businesses by providing critical working capital that would otherwise be unavailable through traditional banks. It's important to note that the U.S. private equity sector drives a significant amount of economic growth in the United States and supports more than 26 million American jobs, which contributes $475 billion in annual federal, state, and local tax revenues. Additionally, the profits from private equity are funding the retirement security of millions of pensioners. According to the American Investment Council, 91% of U.S. public pension funds have invested a portion of their portfolios in private equity. In Michigan, for the state of Michigan's pension fund, that means $71.2 billion. Needless to say that investments made by the private equity industry in our local communities all across the nation are playing a vital role in job creation, wage growth, and retirement savings. In my district alone, private equity firms have helped create or sustain over 5,700 jobs, and private equity investment was $4 billion, helping companies such as JR Automation in Holland, Brillcast in Grand Rapids, Challenge Manufacturing in Walker, and I could go on. Private equity is a fundamental part of our economy and plays a direct role in our districts by working to make businesses more successful. I look forward to hearing from our witnesses today, and I yield back the balance of my time.
I want to welcome today's distinguished panel. Eileen Appelbaum, Co-Director, Center for Economic and Policy Research. Wayne Moore, Trustee, Los Angeles County Employee Retirement Association. Giovanna de la Rosa, United for Respect, who worked at Toys R Us, employee for 20 years. Drew Maloney, President and CEO, American Investment Council. Brett Palmer, President, Small Business Investor Alliance. Without objection, all of your written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony. When you have 1 minute remaining, a yellow light will appear. At that time, I would ask you to wrap up your testimony so we can be respectful of both the witnesses and the committee members' time. Ms. Appelbaum, you are now recognized for 5 minutes to present your oral testimony.
Sorry, Committee Chair Waters, Ranking Member McHenry, and distinguished members of the committee, I am very pleased to be here today to discuss private investment funds. Most private equity deals are used to acquire small and medium-sized companies, and here my research shows that private equity can bring know-how that makes a positive difference. These investments generally have higher returns than acquisitions of big companies. But in what one finance writer called the paradox of private equity, most private equity money goes into acquiring large companies that offer few opportunities for improving operations and many for financial engineering. Activist hedge funds take small stakes in major companies and then call the shots. Hedge funds make money from short-term increases in share prices, then sell before the negative consequences are apparent. Exemption from regulations that rule out risky behaviors enables private funds to gamble with the future of acquired companies while funneling money to wealthy private equity partners. Private investment funds play a significant role in the U.S. economy. Over the past decade, assets managed by hedge funds and private equity funds have exploded. They doubled for hedge funds, septupled for private equity funds, and now exceed $3 trillion for each. There were nearly 10,000 private equity buyouts between 1980 and 2013, according to a study by Chicago and Harvard economists. They had data for 6,000 companies employing 6.9 million workers at the time of the buyout. 13% of workers at publicly traded companies lost their jobs in the next 2 years. Overall, 4.4%, or 304,000 workers, lost jobs. Big private equity firms buy out large, viable companies and use their assets as collateral for risky levels of debt that the company and not its private equity owners must repay. This erodes the buffer that companies have to make it through hard times. Toys R Us is the poster child. It was purchased with $5.5 billion in debt. It went from a capital structure of 87% equity and just 13% debt before it was acquired to an upside-down 17% equity and 83% debt. Yearly interest payments exceeded $400 million, and total advisory and other payments that went straight to the private equity firm were another $470 million, eating up profits. Toys failed, its stores were shuttered, and 33,000 workers lost their jobs. It is this reckless loading of debt onto companies that the Stop Wall Street Looting Act would end by requiring the private equity firm and the fund's general partner to be jointly liable with the company for repayment. Add-ons are another favorite tactic. Private equity firms buy small competitors to add on to an initial acquisition, building national powerhouses without any antitrust supervision. Private equity-owned Envision and Team Health own hundreds of doctors' practices and have more than 90,000 employees in hospitals and other health facilities across the country. Both have multi-billion-dollar loans to pay off. They use surprise medical bills or the threat of such bills to get much higher payments than other doctors receive, driving up healthcare costs. Hedge funds pursue profits through the purchase and sale of stock in publicly traded companies. Stock buybacks that were illegal before 1982 because they are a form of market manipulation are widely used by hedge funds to raise share prices and then cash out before the effects of draining resources, like the plant closings at General Motors, become apparent. As we speak, AT&T management is capitulating to similar demands from a hedge fund that owns just 1% of its stock. At DuPont, the hedge fund firm used the small stake to break up the company and shut down a premier research facility that was a major source of U.S. innovation. It sold its shares before the reorganization was completed. The Reward Work Act would make stock buybacks and manipulation of share prices illegal again. The Stop Wall Street Looting Act will bring the incentives for private investment funds in line with their stated aspirations to improve operations at companies they invest in. This and other pending legislation will reduce opportunities for financial abuse and assure that capital is deployed in support of economic growth and rising living standards. Thank you.
Thank you. Mr. Moore, you are now recognized for 5 minutes to present your oral testimony.
Chairman Waters, Chairwoman Waters, Ranking Member McHenry, and members of the committee, I'm honored to be here this morning as a public pension fund retiree, trustee, and taxpayer. As a fiduciary, I'm responsible for protecting public pension plan assets and ensuring promised benefits are delivered. That begins with openness and transparency between us and the asset management industry. Public pension funds will pay up to $45 billion in fees and expenses to the industry this year, a massive transfer of wealth from workers to Wall Street. My fiduciary duties include making sure we get what we pay for. More than 20 million active and retired public employees have accumulated over $4.5 trillion in assets to provide for their secure retirements. They are often overlooked during discussions about complex legal and financial strategies, profits, and bonuses. It is past time for workers to exercise greater oversight over their assets. Along with openness and transparency, we must have cost-efficient investment practices, fair returns, and outcomes that support a growing economy. My constituents expect no less. Last year at the Los Angeles County Employee Retirement Association, where I'm a trustee, 3,800 general members retired. They received an average annual retirement benefit of $45,400. Controlling and minimizing the cost of investing through a more open and transparent data collection regime as proposed in H.R. 3848 is not an inconsequential exercise. If we could save just $1 million in the cost of investing, those savings invested at 6.25% would fund 2 average LA County pensions for 20 years, including a 2.5% annual COLA. While private equity is our pension fund's best performing asset, it is also our most costly asset. While just 10% of our portfolio, private equity makes up over half of our investment management costs. Over the past decade, many initiatives have been launched to address transparency issues with private equity managers. While much has been accomplished, for example, California's AB 2833, more needs to be done. The disclosures proposed in H.R. 3848 are important to investors and the public, as more complete information means sounder and more meaningful asset allocation decisions. Public pension funds are eager to participate in the growing worldwide private economy. As a matter of fact, in 2019, Prekin reported that 31 U.S. public pension funds provided 35% of worldwide allocations to private equity firms. We do not, however, want to participate through financial engineering, destabilizing our communities, and undermining our future for short-term gains. Many fund sponsors, participants, and beneficiaries want to see ourselves in our investments, people who look like us making investments that will favorably impact our lives. If I lived in Ohio, I might want to see investments in manufacturing. In California, investments around agriculture and logistics are just as important as technology. Every dollar we earn from investments should be a good dollar. Being informed by the impact of investment decisions on our constituents is good information. Being open and transparent means helping investors in private equity make good decisions. Private equity is not a sector of our economy. They buy stakes in sectors of our economy. However, just buying and owning a company does not automatically make you a job creator or an engine of economic growth. It's the outcomes of what you do after the purchases that is important. As a major stakeholder fueling the private equity industry, pension funds must have a greater oversight role in our investments. After all, it's our money. Thank you.
Thank you. Ms. De La Rosa, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, for inviting me to speak today. I'm honored to be here. My name is Giovanna de la Rosa, and I am from Chula Vista, California. I worked at Toys R Us as an assistant manager for 20 years before private equity firms drove it to bankruptcy. I'm here today as a leader with United for Respect to speak on behalf of the 1.3 million workers who have lost their jobs to private equity. I started working at the Toys R Us store in Chula Vista when I turned 18. I grew up in that store and have deep emotional ties to it. I got to work there with my sister and other family members. I met my then husband at work, and our son was a true Toys R Us kid. And of course, I gained a second family in my coworkers. We loved working at Toys R Us, especially around this time of year. Our job was to bring joy to kids and their families. We knew our customers, and I was proud to work for a company that cared about its employees and treated us like family. Then, in 2005, 2 private equity firms, KKR and Bain, and a real estate investment trust, Vornado, acquired Toys R Us through a leveraged buyout. After that, the old culture was thrown out the window. From day one, they started making all kinds of cuts that weren't needed. They cut staff and benefits, but we had to keep it together as a team with limited resources. I thought these new Wall Street owners were coming in to make our company and operations work better. I had no idea what private equity or leveraged buyouts were, but they were making things worse. And then everything fell apart. My life changed that spring when news hit that Toys R Us stores were shut down nationwide and lay off over 30,000 of us without a dime of severance pay, despite our years of dedication to the company. I started having breakdowns at home and work and had to pull it together for my team and for my son who has special needs. It was hard to imagine how I was going to make rent or afford health care for us. How could I tell my special needs son that someone on Wall Street made a series of decisions that turned our lives upside down? I couldn't find anything but seasonal work for over a year, despite my experience. My coworkers and I were left with nothing, while the executives and private equity owners walked away with millions. I heard later that Toys R Us paid $470 million in fees to private equity owners. That would be enough to pay over $14,000 in severance to each employee who lost their job, versus the $800 that I got. So this is why I got involved in the fight to hold private equity accountable. I joined United for Respect and thousands of other Toys R Us workers to demand justice and severance pay. We told our stories everywhere, from Congress to pension fund meetings to the press. And because of that, KKR and Bain finally started talking to us about a hardship fund for Toys R Us workers. They set up a historic $20 million fund for us, which helped a little bit. But it wasn't enough, and it didn't help us get back the financial security we had when we were working. Luckily, Toys R Us is making a comeback, and the new owners reached out. Together, we formed a mirror board made up of 3 former Toys R Us employees, including me, to help guide the new company. I'm excited for the chance to bring Toys R Us back the right way. Over the past year and a half, I've learned that Toys R Us workers aren't the only ones who went through this buyout hell. Other retail workers are also going through the nightmare of having private equity firms or hedge funds putting their stores out of business. I met workers from Gymboree, Sears, Payless, Kmart, Shopko, and they all had the same story as me. And they knew the names of the Wall Street firms that made them lose their jobs: ESL, Alden, Sun Capital, and many more. Because of private equity investments in retail, 1.3 million jobs have been lost. That's 1.3 million people with kids, parents, and grandparents who also lose their financial security. We need real deep change like the Stop Wall Street Looting Act. The last time I was in DC was to help introduce the bill with our amazing partners at American for Financial Reform, Center for Popular Democracy, and in Congress. I believe that this bill can protect jobs by regulating private equity so they can't make money by putting people like me out of work. And now our fight has caught the public's attention because more and more people, from retail workers to nurses to grocery store workers, are speaking out. The economy isn't successful and thriving when so many of us are losing our jobs. What would you do as a single mom raising a special needs child, then being left with nothing? No job, no income, no health care. We're counting on you to do the right thing and pass this bill. We're waiting to see which side you're on, working people or Wall Street billionaires. Thank you.
Thank you, Ms. De La Rosa. Mr. Maloney, you are now recognized for 5 minutes to present your oral testimony.
Good morning, Chairwoman Waters, Ranking Member McHenry, and other distinguished members of the House Financial Services Committee. Thank you for the opportunity to testify today. My name is Drew Maloney. I lead the American Investment Council. We are proud to represent private equity firms of all sizes. Our industry creates jobs, powers the economy, and strengthens the retirements of millions of Americans. Our industry provides businesses with the capital and expertise to grow. The term private equity is very broad. So before I go any further, I wanted to take a minute to talk about 3 main forms of private equity: venture capital, growth capital, and buyouts. Each describe investments at a different phase of the business cycle. Venture capital represents those early investment in startups that need capital to exist. For example, private equity made early investments in Uber, Spotify, and Peloton long before those companies became household names. Growth capital is when private equity invests to expand an existing company. Growth capital represents the largest part of the investment chain. A great example is Tate's Bake Shop, founded in New York by Kathleen King when she was 21 years old. She partnered with private equity to grow the business, and now Tate's cookies are in grocery stores across America. Finally, buyouts. Buyouts are private equity investments in well-established companies that may be distressed or underperforming. Private equity helped Hilton Hotels almost double in size during its 11-year investment in the company. Hilton was recently recognized as the best company to work for in the United States. The ultimate objective of each of these investments is to build a better business. Private equity provides patient, long-term capital that allows management to think beyond quarterly earnings and short-term fluctuations in the stock price. Private equity also provides more than just capital. Firms bring operational expertise to each investment and often work closely with management of each company to define strategy and map out long-term growth objectives. The biggest investors in our industry are pension funds and university endowments. Successful private equity investments strengthen the retirements of public and private sector workers, including teachers, firefighters, and police officers. In total, the private equity sector in the United States employed 8.8 million people and paid $600 billion in wages and other benefits in 2018. That included more than 1.1 million jobs in California. Roughly a third of those private equity jobs were in either manufacturing, construction, transportation, or warehousing. Private equity invested $685 billion in more than 4,700 businesses across the U.S. last year. Most of these deals are small, mid-sized companies. Businesses of every size in every congressional district depend on private equity capital and expertise to grow. In 2014, private equity invested in Inland Coatings, a small industrial coating manufacturer in Adel, Iowa. The investment helped the company grow to an industry leader and provide health care and retirement benefits to its employees. 91% of public pension funds have invested a portion of their capital in private equity. And in 2018, we generated the strongest returns of any asset class over the last 10 years. The Los Angeles County Employees Retirement Association had one of the highest average annual returns in the country. Earlier this year, the chief investment officer of CalPERS, the country's largest pension fund, said, "We need private equity, we need more of it, and we need it now." These strong returns have become increasingly critical for pension funds at a time when many do not have enough money to meet their existing obligations. Private equity is proud to help close that shortfall. Thank you again for giving me the privilege of appearing before the committee today. I'm grateful for the opportunity and look forward to answering your questions.
Thank you very much. I now recognize myself. We have one more? Okay. Mr. Palmer, you are now recognized for 5 minutes to present your oral testimony.
Thank you very much. My name is Brett Palmer. I'm president of the Small Business Investor Alliance. SBIA was formed in 1958 to represent small business investment companies, the original American venture capital and private equity funds. As the small business investing market grew more complex, so did SBIA. And SBIA now includes small business investment companies, rural business investment companies, business development companies, as well as conventional private equity and debt funds. These private equity funds pursue a wide range of investing strategies because this is a continuum that spans from the early stage venture investors to the latest stage buyout and everything in between. While we segment these investing styles for the sake of simplifying and explaining them, the reality is they are all inextricably interconnected. Our members also include institutional investors, such as university endowments, that invest into private equity and where they get their best returns. Private equity is a real and mutually beneficial partnership. As such, our public policy goals are balanced and focused on maintaining a robust, healthy, and competitive market for investing in American businesses. Good public policy should increase the capital options available for a company's success, whether that company is a startup business proving its products in a competitive market, a small family-owned manufacturing business managing through generational succession, or a larger company, including retail companies that are trying to adapt to a new competitive threat in the form of technology and e-commerce, as well as take advantage of those opportunities of e-commerce. Our members grow businesses and are rightfully proud of what they do, of how they do it, and the benefits their actions have on people and on communities, because private equity is a force for good, a source of job creation, and a driver of innovation. Private equity supports the retirement security of millions of pensioners and provides endowments the money they need to provide scholarships and educational access to a new generation of college students. And private equity is also invested all over the country, including into areas of the country that are otherwise passed over or passed by. Most of our member funds are in places like Little Rock or Indianapolis, Buffalo, Kansas City, and other places that are far from Wall Street or Silicon Valley, though we do have investors there too. But regardless of the investing style, private equity investors in small and medium-sized businesses make money by helping the businesses grow and succeed. The idea that private equity funds succeed by having businesses fail just isn't true. The only way to be a successful private equity fund in the lower and middle market is to find smaller businesses, help them grow to be bigger, better, stronger businesses. And private equity provides patient capital that conventional banks cannot provide themselves. They help businesses make big leaps forward that they otherwise would not have been able to achieve on their own. And not having the resources to embrace change that happens in the economy on a constant basis creates more risk. The more capital options a company has, the better chances it has to survive and succeed in the long term. If a business cannot survive and adapt to change, it cannot maintain its employees, and it cannot much less add new employees. If Congress can agree on one thing, we would hope that Congress should agree that regulatory and tax policy should promote and empower private equity to invest into more growing American businesses. Congress should reject policies that make it harder for private equity to provide access to capital, particularly to smaller and medium-sized businesses that already face disproportionate challenges to capital access. We need more investment, not less. While providing growth capital is core to what private equity does, it is not just money. Successful private equity managers invest in people. That is why SBIA partnered with The Ohio State University's Business School to train business executives of how to grow their business. Just this month, over 45 small business executives took part in a 3.5-day intense training seminar on how to maintain their employees, how to attract new employees, how to manage growth, how to successfully operate in a leveraged environment, and how to create successful strategies. In other words, our private equity funds are training their businesses how to grow their businesses by investing in their employees and by investing in their customers. Again, private equity can only succeed when the businesses grow, and growing businesses need to retain their employees, and they need new employees to help that growth. I would like to close with a real-world example of what private equity does. The Florida Autism Center provides center-based autism therapy services to children throughout Florida. In 2016, Resolute Capital Partners out of Nashville invested both debt and equity capital in a small platform that had only 5 centers and served 50 children with 70 employees. The company will end this year with 51 centers, serving over 1,000 children with over 900 employees, and has expanded into Georgia. The company was founded by a woman who started her career as a behavioral therapist. It has been led by a female CEO throughout this stage of growth. This is a growing business. This is the kind of business that changes people's lives, and this is what private equity does. With that, I would turn back and answer any questions you may have.
Thank you very much. Let me thank all of our witnesses for being here today. Allow me to take a moment to say to Mrs. De La Rosa that your testimony to us today was extremely revealing, and you have basically described to us the impact that this basically undermining of Toys R Us by private equity firms and managers such as Bain and KKR has had on you, your families, and other employees of Toys R Us. As a matter of fact, Toys R Us is our case study about private equity firms, and so your being here today is not lost on us at all. Thank you. Dr. Appelbaum, because people's lives and health are at stake, as well as concerns about equitable treatment for all communities, emergency medical services and other industries related to health and public safety do not operate like for-profit firms. Studies have shown that when private equity firms move into health-related industries, costs go up, standards and quality of medical care decrease, and emergency public health response times lag. Just last year alone, ManorCare, the second largest nursing home chain in the United States, realized an astonishing 26% increase in its total annual health code violations after it was acquired by the private equity firm, the Carlyle Group. And according to the New York Times, TransCare EMS, which was taken over by the private equity firm Patriarch Partners, was forced to close its doors up and down the East Coast, including in Mount Vernon and Brooklyn, New York. Many have argued that there are certain sectors, especially industries related to public health and public safety, that are too sensitive for private equity firms to be operating in. Now, you've heard and you know all about Toys R Us, and I don't know what you know or understand about what I just described in relationship to health and public safety. Can you tell us, Mr. Appelbaum, Ms. Appelbaum, why you think private equity firms should acquire public services such as health clinics and hospitals and fire departments, et cetera, given the information that has been basically understood now about what they do when they take over these kind of public safety entities?
I think the place to begin is that we are not talking about normal marketplaces when we talk about healthcare, especially when we talk about emergency care, whether it's ambulances, air ambulance, emergency rooms. These are situations in which you do not say, how much are you going to charge me for this? I'd rather have a cheaper ambulance. It doesn't work like that. These are services that you're going to use because you urgently need them, and you have no opportunity to bargain over price, which means that the services are able, if they so desire, to charge whatever prices they want, as high as they want, without losing any business.
Do you think private equity firms should be allowed to take over these kinds of services?
I do not think so, because they...
What about you, Mr. Moore? Do you think they should be allowed to take over these kind of services?
It depends on the strategies that they're going to employ in taking over the companies.
I can't hear you.
It depends on the strategies that they're going to employ.
Well,
when they
we
take
know,
over
we
the
have
company.
information now that they have slowed down response times, et cetera, et cetera. So, given the information that we already know about them, do you think they should be able to continue to take over public health?
Given that information, I would say no.
What about you, Ms. De La Rosa?
No, ma'am. The way we were...
Mr. Maloney?
Yes, I believe we can be responsible investors in the healthcare investment community.
I beg your pardon?
Yes, I believe that we can be responsible investors across all sectors, including healthcare.
What about the evidence that we already have? Should we just forget about that?
I think there are some isolated cases that are unfortunate, but overall, there are very positive cases out there.
Our research shows that it's not isolated.
Well, Madam Chair, there are great examples of investments that we have out there in healthcare. For example, in Grapetree Medical Staffing in Iowa is a great example of private equity partnering with a business to increase the demand of nurses and healthcare professionals in Iowa. And after 2 years, that partnership has expanded into...
Thank you very much, Mr. Palmer. What do you think? Do you think?
I don't know anything about owning hospitals. That's not what our guys do. Those are too big. But I will tell you that there are parts of the country that have health care now that did not have it until private equity bought small businesses that were healthcare providers and expanded them into communities that didn't have any. We gave an award to one of those companies, I think last year or the year before, because they provided the first primary care and emergency care services.
Thank you. My
in
time has
Appalachia.
expired, unfortunately. Thank you. The gentleman from North Carolina, Ranking Member Mr. McHenry, is recognized.
So according to, thank you, according to Moody's, private equity-backed firms have no greater bankruptcy rate than non-private equity firms in this country. So there's a big misunderstanding of what private equity is, though. So let's start with the business model, Mr. Maloney. If you're here on behalf of the industry, let's describe what a buyout fund does, since that is the largest piece of what private equity does, though not all of what private equity does. But how does a buyout fund work?
So a buyout fund will pool resources from pension funds, college endowments, and it will go invest with companies that are either in need of growth or large companies that are underperforming, and work side by side with those companies. And I would say that, as you suggested, the overwhelming majority of our investments are successful. That's the only way that we make a return for our pension holders. And if you look at what you said, the 6% of bankruptcy rate, that means 94% of our deals are successful. So the transactions like Hilton Hotels, Dunkin' Donuts.
So the idea is you take capital and you bring some expertise with the capital to improve a firm. Is that, how would you explain it, Mr. Palmer?
That's right. And for a buyout, you're changing ownership. And when you're changing ownership, oftentimes it's a founder, someone who's retiring. There are a lot of baby boomers who started businesses or post-baby boomers who are retiring. and you're taking the next generation, oftentimes of that people who work at that business management, you're buying out the owner, they go away, they stay on for a little bit, they retain some of the ownership of that business, but you apply new technologies, you buy new equipment, you grow it, and that's how buyouts work in the lower and middle market, and they're a really powerful force for job creation and business growth and sustainability. Without that buyout, many of these businesses that are owned by baby boomers would literally shudder, even though they're profitable, good businesses that are employing people today. Not because of bankruptcy, just because there's no one there to take it and run it.
Okay, so then if you have an investment, then you would get debt alongside that investment in order to purchase, right? So if, as an individual, I want to buy a small business, that's what I would do. I go to get a bank and get lending. So how do you get lending if your business model is bankruptcy? All right, great shrug from everyone. It's very difficult to get lending if you're going to put the screws to your lender, right? And then the question of liability. So, Mr. Moore, you're an important member of the board for the investors, right? Do you have individual liability for the decisions that you as a board member make on behalf of your investment fund?
No.
Okay. Does any individual here on behalf of their association or their employer have individual liability if their employer makes a bad decision? I'll take that as a no across the panel. As members of Congress, for the decisions we make on behalf of our constituents, do we have individual liability? No. So the Warren bill here today would apply liability to the employees of the private equity firm and the investors of the private equity firm. That would be a new form of investing, which would be a real regression for investment capital and business structures. So along those same lines, the business model of bankruptcy doesn't get lending. So therefore, the bankruptcy rate question, I think, is a material one here. Now, the decision for your pension fund, Mr. Moore. I read that recently the board made a unanimous decision to deploy 150, was it million or billion?
Million.
Million, 150 million. It's Washington, I've got to ask those questions, sorry. In a buyout fund, is that correct? Mm-hmm. And did you support that decision?
Yes, I did.
Okay, so in terms of private equity, even with the high fees that you pay, as you testified, is private equity still your top performing investment for your fund?
It has been for about the last 10 years.
Okay.
So we're active
Even after fees?
Even after fees.
Okay.
It could be even more if the fees were lower.
Of course. And I think California and CalPERS and your fund have significant power in that. So with that, it looks like the business model is, we have a better understanding of that. The understanding of bankruptcy is no higher than non-private equity firms. And the idea of new strict liability for individuals employed by private equity is not commensurate with who we are in our American capitalist structure. Yield back.
Thank you. The gentleman from New York, Mr. Meeks, who is also the chair for the Subcommittee on Consumer Protection and Financial Institutions, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you for having this hearing today where I think that we need to have an important conversation and discussion because I think we do get confused at times which way to go, and sometimes you want to knock the whole industry out as opposed to looking to see who may be on the bottom and what we can do. What are our responsibilities as members of Congress to make sure that individuals like Ms. De La Rosa and her family and those are there, that they have a softened blow. But at the same time, we know, as I've heard from Mr. Moore, that we have individuals who are pensioners and others who are dependent upon a return on investment from private equity so that they can retire and live in a decent space, and we want to make sure that they get that return on investment also. So we have still trying to figure out how we work it out so that the average, every hard-working American get the benefits that they deserve. And what do we do when we have a company that is, and going by what Mr. Maloney was saying, that is distressed, about to go bankrupt, about to go out of business? You know, I have right now a scenario where there is a company happens to be a minority-owned company, in full disclosure, that I'm trying to get some private equity dollars in, because if I don't, they're out of business. They're out of business. They have no alternative. So they're coming to me to say, help me. Can you help find somebody that would invest? And part of my struggles is to make sure that some private equity firms are investing more in minority-owned firms so that they can continue to exist and grow and be part of the road capital. Because oftentimes, minority-owned firms don't get the road capital so they can expand their existing businesses and move forward, and I find the discrepancy therein. And so part of what I want to do is to make sure that we're able to make sure that there is diversity in regards to my community. For example, JFK Airport. I've demanded, working with my governor, that 30% equity for minority firms in that airport, and we're getting it. And they need some investment, and so oftentimes some of those minority firms that are those 30% partners are getting that investment so that they can then do, and they working in cooperation with the community, and in my case, in cooperation with SEIU and the Teamsters and other labor unions, so that we're working collectively together, because the labor unions also are concerned about their pensioners also, so that we're all working together, and that's why this conversation is important. I think furthermore, what we need to explore, and with the real, and I've raised it previously in this committee, that I do have concern about, because when you talk about the overall economy, and I go back and forth, and here is what effects, and I think this happened with Toys R Us and others, does leverage lending have? And can that overburden us so that we could get into a financial crisis in the manner that we did in 2008? And so I want to continue to have dialogue and conversation. I don't fully understand to be, or have made a decision, but I want to make sure that we look at it. I think we have a responsibility as a committee. That's why this hearing and others are tremendously important as a committee, to look at what effects does leverage lending have on our overall economy, and what effects does it take place. I think what Chairwoman Waters was talking about, which I think is tremendously important, when you talk about public institutions, whether or not there are sacrifices maybe we have to go overboard. For example, I know we had this big crisis in regards to the VA hospitals and timing and what happened. So do you put in measures that may increase the time that a medical person or a patient gets to see a doctor because of trying to manage it? What is the pros and the cons? And I think that's a good discussion to have. And I think that's what she was talking about with reference to some of the evidence. And that's a good, healthy discussion to have. But, I'm about out of time, and I wanted to ask Mr. Maloney, specifically, though, because I see on the minority private investment companies, and you represent a lot of them, that they have outperformed a lot of the benchmark of all U.S. private equity firms. But despite that evidence, the number of diverse private equity firms remains very low. So I was wondering, what, if anything, that we can do to address the biases against diverse private equity firms that I see that's taking place in our country today?
Congressman, thank you for that question, and thank you for your leadership on this issue and your support of the JFK project. And I think the JFK project is one that highlights what we continue to do and can do on a national basis, which is not only do we partner with labor, but we also partner with minority-owned firms like we are in New York. And we all understand that diversity makes us stronger, and we are committed to working with you on projects like that and expanding those projects. Thank you.
Thank you. The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and I want to start by thanking the witnesses for being here to testify today to examine the private equity industry. Private equity helps grow American jobs and gives everyday Americans more comfortable retirements by providing returns to pension investments. The private equity industry supports American companies and jobs throughout the country, and a recent study found that in 2018, the U.S. private equity sector directly employed 8.8 million workers who earned approximately $600 billion in wages and benefits. The average worker in a private equity-backed company earns approximately $71,000 in wages and benefits, and that translates to around $36 per hour. In my congressional district alone, There are over 47,000 constituents working at private equity-backed companies. And over the past 5 years, Missouri's 2nd congressional district has received $17 billion in private equity investment. Without access to private equity, many American businesses would not be able to expand, hire workers, and provide the crucial services for their local communities. Mr. Palmer, there have been claims that private equity funds are under-regulated. What sort of regulations are private equity firms subject to?
Well, it depends a little bit on the type of private equity fund. You actually have a buyout fund in your district, Holly Hewells, who I think you've met in the past with
Correct.
Hathaway Capital. It specializes in investing in small manufacturers and taking them to the next level as they have generational transfers. But private equity funds are regulated as far as who's allowed to invest into them. They have to, if they're regulated, they're small business investment companies, they're regulated by the SBA. If they're conventional private equity funds, they're regulated by the SEC. There have to be all sorts of disclosures. There have to be controls on what they do and how they do it. There are all sorts of protections that are in regulations that aren't formally government regulations that institutional limited partners like Mr. Moore put on private equity funds that are in their limited partner agreement that require transparency and require good practices and prohibit bad actors and investing in businesses that institutionals would not be proud of. There are a lot of restrictions that are out there, but the funds themselves need to be able to move at the speed of business.
How would the additional regulations being proposed today impact not only the private equity industry, but the companies backed by private equity, the employees of those companies, and the smaller pension funds seeking to maximize returns for pensions?
Well, the Stop Wall Street Looting Act, though well-intentioned, actually harms Main Street far more than it even limits Wall Street.
Absolutely.
And it would cut off capital, create a significant disincentive to be investing in businesses because of the liability being transferred up, even for founders. Because if you maintain 20% ownership in the business, which is in the bill, you're a control person. So if you have a founder who's retiring, buying out, but that he or she still owns a piece of the business for 3 or 4 years while they're helping the next generation take that business on, if that business were to fail because of some technological change or some market shock, that person not just loses their share, they have all this liability transferred on, they lose everything. That's not the way this is supposed to work.
The Stop Wall Street Looting Act, which is Senator Elizabeth Warren's bill, would establish vast liabilities on private equity investors and impose controls on when and how investors can receive their money back. Mr. Palmer, in your view, what would the impact of this bill be on the private equity industry and on the middle market economy?
I think there'd be a lot less investing into businesses. There'd be a lot less lending into businesses. Most lending works. And bankruptcy exists for a reason, but most lending works. Most of it's constructive, most of it's positive, most of it's growth-oriented, particularly for smaller businesses that aren't liquid. They can't just sell their stocks on the NASDAQ or the New York Stock Exchange. They have to go to private equity in the private markets. If they don't have access to capital, they don't grow. They get stale. They lose in a global competitive market.
How many jobs would be jeopardized if the private equity industry was unable to provide capital to small and middle market businesses?
You would have the ceasing of, for one, you'd have some jobs that are lost immediately, but also on a going forward basis, you'd have millions of jobs that just wouldn't be created. And a lot of those jobs that wouldn't be created are in manufacturing and businesses that need to constantly be changing and that aren't in necessarily Silicon Valley or Wall Street.
I don't have much time here. Plainly, would there be more jobs or fewer jobs in America if H.R. 3848 became law?
A lot fewer.
Would there be more investment or less investment?
Less investment.
Would the university endowments be better off or worse off?
Worse off.
Thank you, sir. I yield back.
Thank you. The gentleman from Colorado, Mr. Perlmutter, is recognized for 5 minutes.
I'm just going to take a minute. I guess on this subject, I'm more where Mr. Moore is. There's a continuum of private equity folks, from good actors to bad actors, from those who are going to put in primarily equity and capital to those that it's mostly going to be debt-driven, those that want to bring good management skills and grow the organizations and stabilize the organizations, to those that want to strip out whatever golden nuggets might be, find gold under some retail operation. And so this is definitely a one-size-doesn't-fit-all. And You know, I practiced bankruptcy law for a long time before I was elected to Congress, and business bankruptcy, and we saw leveraged buyouts where there were some real bad actors who had, you know, primarily in the mining business and in the extractive industries. But you know, a lot of this has to do with the chicken and the egg. Is there a problem? And I'd say to Ms. De La Rosa, I mean, is there a problem with the organization going in? Are they struggling financially? Is retail sort of on the ropes because of an Amazon? Or is it because a group comes in that is predatory in nature and is just going to strip out the good things and leave nothing but the bones, you know, those we call the vulture funds or the vulture capitalists? So, Mr. Moore, I'd like you to expand on your testimony. I'd like to see the pension funds and the others have more information available to them. I certainly would like to see that. And then, Ms. De La Rosa, I want to talk to you a little bit about the retail business and the future of it.
Well, Mr. Permuller, first off, I think it's a false narrative to say that money will not flow into companies that needed it to grow and expand just because they can't receive it through a private equity construct. The money will flow to where is needed without regard to whether it comes through private equity, a bank, individuals, and multiple other sources. Secondly, you were saying that there's a whole continuum of private equity investment strategies. And we have been successful at Lacera, at our pension fund, in identifying strategies in industries that looked promising, that didn't have negative impacts on our workers, and that looked like they were going to be in the future. For example, we were early investors in Silver Lake and Vista, and those companies focused in technology and family-owned businesses and helping them grow. And no one can deny that some of the buyout firms' specific strategy was to go into companies that had value and extract that value and leave the company because their time frame is 5 to 7 years. They're not in it for the long term, many of them. So in conclusion, I would just say that the strategies that are being employed by the companies is very important, and that's why we need to have transparency, and the regulations or the rules that are promulgated through HR 3848 would help us get the information we need and all the other pension funds need to make good, reasonable decisions on who to invest in so that we don't have the type of problems that we have with Toys R Us. And the last thing about Toys R Us is, if Toys R Us had not been layered with all of this debt, without the ability to invest in the infrastructure they needed to be an online retailer, they might still be here today, and all of those people would still have their jobs, but the buyout firms went in, took all the value and all the money they could get out of the firm, and then left it high and dry.
Okay, thank you. And I just say, for you and the other pension funds and those that really bring the money, I mean, ordinarily, I'm not sure we got to have legislation, but I'm happy to deal with that. But usually, those with the gold make the rules. And I want to make sure our pension funds, you know, do get to develop the contracts. To Ms. De La Rosa, so when you were working at Toys R Us, I mean, when they came in and made the buyout, did you see them strip out the value right away, or how did that work?
Yes, sir, it was right away. Cutting of jobs, positions, changing of operating companies that we used, contracts.
Okay, thank you for your time.
The gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Thank you, Madam Chair, for holding this hearing, and Mr. Ranking Member. Today we have before us a piece of legislation that could restrict one of the long-standing features of our market-based system of finance. The feature is a concept of limited liability or limited liability corporation. The history of our financial system is marked by innovations that have helped us manage risk that might have otherwise discouraged investment and growth in our remarkable economy. One of those innovations was limited liability corporation. In writing about 1811, New York law created the limited liability stock company. Robert Shiller, Nobel economist, says the law further democratized finance by clarifying that shareholders would never be held liable for the debts of corporations. The law made it possible for the first time for a small investor to hold a diversified portfolio consisting of stocks in many companies. Prior to the advent of limited liability, one could not have done such a thing for fear of a lawsuit from any of the companies that he held stock with. This development created a ready pool of investors with whom investment bankers could place newly issued shares. After seeing how a steady supply of capital for new businesses this innovation produced, countries all over the world copied it. We, of course, need to be cautious about restricting such an invention that has served us so well over the years. I say this while also understanding the pain of business failures and the loss of jobs, tax revenues, and other economic contributions to our communities. I believe we have to realize that a private equity firm doesn't acquire a company to have it fail. They intend to make money from a stronger firm. Unfortunately, their aims are sometimes frustrated by the market for goods or services of the underlying firm. But we must understand that success means stronger firms, job growth, and overall great contributions to our community and our countries. Mr. Maloney, can you share with us your assessment of the economic impacts of the Stop Wall Street Looting Act of 2019? Specifically, which sectors of the economy are most likely to be affected if this bill becomes law?
Thank you for that question and your concerns, Congressman, about eliminating sort of the traditional limited liability protections that allow for investment in the current marketplace. According to a recent study by Professor Swenson from the University of Southern California, he suggests that the loss of jobs would be between 6.2 million and 26.3 million jobs in the U.S., and that the loss of tax revenue could be between 109 billion and 475 billion, and that public pensions would lose up to $329 million. So what would happen is if the public pensions don't have this top asset class to go to, and as Mr. Moore said, you know, at his fund last year they returned, I believe, 21%. That you'd have.
That's wrong. Sorry.
That's okay. But my point is it's a high performer, and you'd have to switch asset classes to a class that doesn't perform as well.
Okay. Mr. Palmer, do you agree?
I do. And you asked the question of which businesses would get less, capital and what would come out. The businesses that are asset light, and a lot of businesses in their new economy are asset light, would not be able to get loans. They would not be able to get access to capital, and so you would really have a shrinkage in the access to capital. Would capital be available? Yes, potentially, but it might be more expensive, and in many cases, it might not be available at all.
Okay. The critics of private equity funds promote the perception that PE firms makes lots of money even when one of his acquisitions goes bankrupt. Can you clarify the impacts of a typical case of such bankruptcy for the PE firm? Mr. Maloney and then Mr. Palmer.
As we've discussed, bankruptcies in private equity are very rare, and nobody succeeds in a bankruptcy. We try to grow businesses and increase jobs.
Thank you.
Bankruptcies are you lose money. It's just that simple. There's no good way. I mean, you might be able to save a business in buying a business out of bankruptcy and try to reinvigorate it. That's possible, but in bankruptcies, there's no winning strategy.
My time has expired. Thank you, Madam Chair.
The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to our witnesses. You know, this is, you know, as a scientist, I guess, and a businessman, I find myself a little bit frustrated by that we seem to be having this argument by anecdote rather than statistics. And you know, the difficulty is, I guess I put myself to sleep last night reading one of the papers that was mentioned in the memo distributed by the committee from the University of Chicago called "The Economic Effects of Private Equity Buyouts." And you know, there were some interesting numbers in there. For example, the employment targets of private equity buyouts rises 13% in firms that were previously under private ownership, and 10% on what are called secondary buyouts, where you have sales from one PE to another. However, the employment falls by 13% in buyouts of publicly listed firms and falls by 16% in divisional buyouts. And so trying to understand, you know, the multiple faces of private equity that we've been talking about is, you know, at least to me, sort of frustrating. And so, you know, there are many variables in it. We have, you know, what sector the firms are operating in, what the holding period, the target holding period is, whether they're public versus private firms, and whether they're generational transfers or ongoing businesses, and of course, just the size and degree of leverage. And so can any of you or all of you maybe come to an agreement on what the red flags are that signal, you know, a troublesome aspect of this versus things that tend to result in good results? You know, what variables should we looking at to try to separate the wheat from the chaff here?
So I think that one thing that we have to say about the private equity business model that has not been said is that the debt is put on the company that is acquired. It has to repay it. But the decision to put the debt on it is made by the private equity firm. So the private equity firm goes out, decides how much leverage to use, and then it's the company that has to pay it back. And the private equity firm and the general partner have no responsibility for this whatsoever. This is the crux of the problem. In the small and medium-sized companies that we've been talking about, they have very little in the way of assets that can be mortgaged, and so the level of debt is quite reasonable. Those companies are not going to be affected by the Stop Wall Street Looting Act because the level of debt is so low. In the case of those publicly traded companies that you mentioned where all the jobs are lost, these are big companies. They're publicly traded. They already have good operations in place. They already have good business strategy in place.
Well, is that necessarily true? I mean, it's not clear to me. I don't know the history of Toys R Us, but a lot of big box companies, public and private, have had rough times in the last decades.
So we did I myself did an analysis looking at Albertsons, which is private equity owned supermarket, compared to Kroger's, which is not. They both face the same kinds of problems: e-commerce, Amazon, Walmart, whatever you will call it. Kroger, because it controls its own resources, it's not paying out to any private equity firm. It does not have high leverage. It's not paying interest on debts. It has been able to modernize. It can do anything that Amazon can do. Its Moody's rating has gone up. Its contributions to its workers' pension fund to make up for the financial crisis has gone up. And Albertsons is on the ropes. It can't go back to the public markets. Nobody wants to buy it. It tried to do a reverse a merger with Rite Aid, and those shareholders rejected it. It's on the ropes because it has not made the necessary investments.
You mentioned that by and large the smaller buyouts you thought were not problematic, and that private equity was a plus in sort of limited size buyouts. Is that something that the entire panel would agree? At least that sector is probably an area where private equity is a net plus across the across the economy?
Well, that's where a lot of my folks are, and they certainly see it that way. There's certainly the greatest opportunity for growth because you're small. You can't shrink it and cut costs because if you shrink small, it goes to nothing. So you really is more growth-oriented in the buyout, but there is also much greater access to capital at the higher ends and much lower access to capital, both debt and equity at the lower end. So there's, on my written testimony, page 5, I sort of have a visual of that. But but the small buyouts are good, but middle buyouts are also very good.
Yeah.
I don't know.
So the I'm trying to understand if there's a consensus that, you know, small or say middle, however you define middle, is also probably an area where private equity is a net positive and the existing regulation is perhaps adequate. Is that sort of the consensus here? And the problem, if it exists at all, are in the largest? Anyway, if any of you could follow up with me on whether we can actually segregate off one segment for higher supervision, I'd appreciate it.
It's a little
The gentleman from
complicated.
Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Madam Chair, and thank the panel for being here this morning. You know, I was kind of curious. I think, Mr. Maloney, you said something about 780 private and equity investments last year. Is that what you said in your testimony a while ago?
4,700.
4,700. Okay, I missed the 4 in front. Wow. Okay, fantastic. So, and there was one of the charts up on the board had there were 35 businesses filed for bankruptcy since 2003. I guess that's major companies, but that would seem to me to be an awfully small percentage of businesses filing bankruptcy versus businesses getting into business. Is that your take on that?
Yes, the bankruptcy rate in private equity and non-private equity is 6%. It's a low rate.
Very good. Well, I was kind of curious, Mr. Moore, what is the breakdown versus on return for your investments on private equity versus other stocks and other bonds and CDs and other types of investments? What's the difference in rate of return?
I can't give you the exact numbers, but I will.
This ballpark's fine.
Yeah, okay. 10-year average private equity for us is about 13%. Public equities in the range of 10, real estate 8, and then the fixed income is much.
Okay, would this be a fair statement to say that the more return you get, the more risk there is with the investment that you're making?
You could say that.
So to me, you know, as somebody who's been in this financial services world for years, return, interest rate, dividends, whatever it is reflective of the risk you take. And so when you have private equity and you're getting much, much better return on that versus more or less risky investments, you want to mix in your portfolio. And so it's important that you have that mix, but you have to understand, and we make that risk, when you make that investment in equities, there is more risk there. As we've just seen, there is an opportunity, 6% of the businesses are going to go under. You have to keep, Mr. Moore, you need more transparency in being able to, as a board member, be able to see how you want to invest in these equities. Can you give me some examples of things that you'd like to see more transparency in when you, as an investor in these equities?
Well, first of all, this bill talks about issues, at least from my perspective, that I'm concerned about in just collecting information on how much it costs and what performance metrics are being used, and have that apply industry-wide and be available to everybody so we can do comparisons. But going beyond that, which is not in this legislation, we would probably want to be more engaged in seeing what kind of companies are in the pipeline, getting more financial information from portfolio companies, so we could have a better assessment of the risks that the companies are taking. You mentioned risks. We want to try to control risk as much as possible. And so if we are noticing that there's a private equity company that wants us to give them an allocation, and they've been heavily engaged in these extractive financial engineering type of activities to generate returns, that might be something we would want to stay away from and look for less risky, more long-term beneficial investments.
It almost seems as you have to have a crystal ball sometimes also to see the trends in industries. You know, for instance, if I was somebody 30 years ago and I was going to make an investment in somebody who builds rotary phones, lo and behold, I wouldn't have anything left today, would I?
Not a dime.
But so you almost have to have a crystal ball to see what the trends will be, where technology will take you. You know, nobody invested in a blacksmith shop 125 years ago. They're in business today either. So, what could be a good investment today, tomorrow, technology or the fad or the general public's twist on things, or preferences could change, and suddenly what would seem in your situation to be a really solid investment to make could suddenly go south on you, couldn't it?
Yeah, but
So-
the better information and the more information you have, the better informed decisions
Right.
you're going to be able to make, and over the long run, you're going to perform better.
Mr. Maloney, Mr. Palmer, I've got 15 seconds left. What about transparency? You guys have some ideas on that as well?
For lower middle market and middle market private equity funds, they get every bit of information that any LP asks for, and LPs can ask for anything, and they'll pretty much get it. So if they want it, they get it, and they do their diligence.
Mr. Maloney, very quickly.
I agree, and we value the partnership we have with Mr. Moore and his pension funds.
Thank you.
The gentlewoman from New York, Ms. Velasquez, is recognized for 5 minutes.
Thank you, Chairwoman Waters. Dr. Appelbaum, I am looking at an op-ed that you wrote in 2015 in the Hill paper. Investors will benefit from greater transparency on performance. Can you summarize your position? And do you believe that limited partners should have more access to the fees and expenses and even disciplinary actions by the SEC of the
Yes.
general managers?
Yes, absolutely, for all the reasons that Mr. Moore has said. At the moment, all of the decisions in a private equity fund are made by the general partner. The limited partners, which are the pension funds, do not get to make those decisions, so Mr. Moore has to figure it out before he makes the investment. He has no control once he's given them the money. And so having transparency, understanding, for example, the monitoring fees that were taken out of toys and are taken out of many other companies, the limited partners generally have no knowledge of that. They have no idea of what that's a side contract between the private equity firm and the company. And the limited partners in general do not have access to that information. And so they have no idea how much is being taken out, which of course will affect the price that the private equity fund gets when it resells the company back to the public markets or to another private equity fund. So absolutely, they need that transparency in order to be able to do their own due diligence on behalf of their beneficiaries. It's very difficult for most limited partners to get information, and those that ask for it or say, I need to make public the contract that I have with you, they have been disciplined by the private equity firms. You would think because this is the source of the money that they would have control. Somebody has already said that. My view is the limited partners need a union, because if they acted together, they could demand information. But at the moment, the private equity firms have the power.
Thank you. Mr. Moore, would you care to comment?
I agree with what Ms.
Your mic is not on.
I agree with Ms. Appelbaum. I'm a policymaker, so I don't have the depth of information and knowledge about the contracts. So I set policy, I review process, procedure, I allocate resources to our staff to implement the policies that we establish, the asset allocations that we want to engage in. And as I stated earlier, information is critical.
Right.
And we lack everything that we need. We do a good job in our firm, our pension fund, because we allocate the resources and staff to do due diligence and travel around the world and pound on our private equity firms that we have money invested in. But before we make those investments, we still have to engage in significant resources in order to dig up information that should just be available not only to us who are actively engaged in it and allocate resources, but smaller pension funds that may not have the same level of resources.
Thank you.
So,
Thank you. And the fact that we, as legislators, care about that, more transparency, access to the information, to look at the strategy in terms of making financial decisions, that doesn't make me a socialist, does it?
no, it just
Okay,
means
good.
you're establishing the guidelines for capitalism that works for everybody.
Wonderful. Thank you. Mr. Maloney, in March, New York City Comptroller Scott Stringer announced a $600 million expansion of the New York City Retirement System in-house Emerging Managers Program in private equity, which is intended to amplify opportunities for smaller managers, including minority and women-owned managers. Are you supportive of programs like the one that Comptroller Stringer announced? And what steps is your organization and your members taking to expand opportunity for smaller managers, particularly minority and women-owned managers?
Well, I had a meeting last month with all of our asset class managers.
I'm sorry, I would like to hear from Mr. Maloney.
Oh, okay.
Mr. Maloney. Thank you.
Thank you, Congresswoman, for that question and your leadership on the diversity issues. As I stated with Congressman Meeks, diversity makes us stronger. We are very supportive of the comptroller's plan. I think a lot of our firms take this very seriously. Sorry.
Yeah, so what does seriously mean?
We are actively engaged with organizations like SEO. We've partnered with Harlem Capital Partners in New York, and the JFK project is another good one. But we're committed to working with you going forward on this.
Thank you.
The gentleman from Michigan, Mr. Heisinger, is recognized for 5 minutes.
Thank you, Madam Chair. And I do need to correct myself from my opening statement real briefly. I had misstated a number. The state of Michigan retirement system, which has a pension system for 515,000 members, has a $71 billion total assets, of which $11 billion of that is directly invested in private equity. I've got a number of things I want to go through real quickly, but Mr. Moore, I do have a quick question for you. CalPERS has set up, or invested, I should say, in $150 million in a PE buyout fund, correct? I think that's what you had told the ranking member?
Yes.
Yeah, okay. So H.R. 3848, which is the House version of the Warren bill, would impose joint and several liability on PE funds, including their partners, their LPs, their limited partners. Sorry if I maybe get my colleague, Mr. Gonzalez, just to scoot back in his chair a little bit. Thank you. How does your board feel about being on the hook with liability?
Well, I can't speak for the board because I'm just one member.
But are you, okay, then are you comfortable with that?
I'm where our board is, which is we have a staff.
Well, wait a minute. Are you speaking for the board or not speaking for the board?
No, what I'm saying is I can't speak for the board. I'm just one member of the board.
Yes.
So as a member of the board, I am going to defer to my staff and my counsel to review this issue, to work with the
Okay, well, so wait a minute. So you're supportive?
Before we take a position.
Okay, I thought I heard you say you were supportive of the Warren bill.
I didn't say that.
Okay, my misunderstanding.
I said there are provisions that I like to implement, I'd like to see implemented. I never said I support the Warren bill.
Got it, okay. So I want to move on here and the Popeyes versus Chick-fil-A debate, Taylor Swift not being real happy with her private equity situation notwithstanding. We've heard a lot about PE and about private equity being raiders and parasites, and how they've basically failed businesses on purpose, and a number of those types of things. What I'm really concerned about is one, I think that those anecdotes that are out there really are not very insightful. But I do want to know why the private sector is turning to private equity versus IPOs. I mean, 20 years ago, we had 7,000 publicly traded companies. We're at about half that right now. Mr. Maloney, Mr. Palmer, feel free to jump in here. Why do companies turn to private equity instead of raising capital through IPOs or other more traditional methods?
Congressman, that's a great question, and it's one that I think you see much more often of a lot of companies staying in the private markets longer. It allows them to grow, and sometimes not, as I said in my original testimony, that they don't have to meet a quarterly earnings statement where they can, if they have a growth stream ahead of them, it's much easier to do that in the private markets than it is in the public markets.
Mr. Palmer?
It's just, a lot of these businesses are just too small. They're companies that are never going to go public. Certainly, it's too expensive and too problematic to be public in many cases. There are too many burdens. But in many of these cases, they're small businesses going to medium. And in many cases, they don't want to be publicly owned. They want to stay inside of a family. They want to stay closely held. And so it's a longer-term patient form of capital where they have greater control over their business.
In fact, I have a number of those in my own district: Challenge Manufacturing, JR Automation, Custom Profile, Hadley Products, Brillcast. Just a couple of examples from West Michigan. And I might add, I've got about 5,700 jobs in my district attached to this. 16 members on the other side of the aisle have 2 to 3 times those numbers of jobs in my committee, yet we're seeing the other side vilify an entire industry, which is providing tens of thousands of jobs in their districts. I'm a little confused by that. But ultimately, it gets down to also risk is a part of it. And Mr. Moore, I wrote this quote down from you. You want to control risk, yet it seems to me you want full return on your money. Well, less risk typically means lower returns. And these companies, for various reasons, sometimes can be riskier investments. Is that not true, Mr. Palmer?
They can be riskier investments, and in many cases, they require a whole lot more hands-on activities than institutional LPs like large pension funds can do. They just don't have the time to get in every business, and frankly, they shouldn't be in every business.
Well, my remaining 2 seconds, I'm going to let you know that I am going to be writing some letters because I would like to hear how, instead of demonizing your industry, what we can do
The gentleman from New Jersey,
to
Mr. Gottheimer,
increase
is
capital
recognized
markets and
for
make them
5
more
minutes.
attractive. Thank you.
Thank you, Madam Chairwoman. If I can start, please, with Mr. Moore. You serve on the board of the LA County Employees Retirement Association. Does your agency invest in private equity funds?
Yes.
Do you know how much, and your 2018 annual report talked about a percentage. You know what percentage of all your assets?
It's pretty close to 10.
About 10%. Thanks. And is that consistent today?
That's what our allocation policy states. That's the range we want to be in.
And why does your agency invest in these funds, sir?
Because it's our best performing asset historically, and going forward, I think there was a question just now about the private markets. That's where a lot of activity and a lot of growth activity takes place, and we want to be part of the growth in our country and the world, so that's where you have to be at some level.
Would you please speak to the returns, net of fees, your agency receives from these investments, please? Like maybe the last 10 years, if you could, a number on that?
Well, we've done extensive analysis in our fund, and I can tell you that our private equity fees and expenses have run about 4.5%.
And overall return, do you know, in the last 10-year return?
The 10-year returns have been about 13.1.
13.1%. And I think if the market the stock market during that time, do you know what
I can't tell you that.
We did a little research on that. I think it was 7%. So 7% versus 13%. And I know if you look at some of the other states, like Massachusetts, over that period of time, at a 13.6% return, Ohio, 13%, Minnesota, 11.7%. Can you speak to the impact that some of the laws in front of us might have on the assets your association has under management, sir?
I'm particularly focused on disclosure and more information on expenses, fees and expenses.
Fees and expenses.
And because it's like low-hanging fruit. You reduce your costs, you have more money in the corpus of your fund, you can grow your fund a little bit more, you can fund a few more pensions, and in the long run, that's what we're looking for, is to be able to deliver the benefits that we promised. So controlling costs is very critical to me, and those provisions in H.R. 3848 that deal with fees and returns get to that.
I mean, it's interesting, I represent the 5th Congressional District in New Jersey, and pensions in my state support many of the hardest working members of our communities, our law enforcement officers and teachers and firefighters who rely on our pensions to provide financial stability in their retirement. Unfortunately, pensions in New Jersey and across the country, as you know, are struggling from years of underfunding, and that's why these returns are so important, and lower performance from the public markets. The Wall Street Journal recently reported that New Jersey's teacher and public workers' pension funds have an average of 43 cents for every dollar in benefits promised, a retirement crisis happening before our eyes. So you talk about these numbers, and the rates of return are incredibly important to make sure that we can shore these up and have the best rate of returns for our teachers and our firefighters and, of course, law enforcement. New Jersey Division of Investment, a public pension fund, has nearly 800,000 members and $78 billion assets under management, 8.7 billion of those invested in private equity. The pension's private equity portfolio produced an annualized return of more than 10% over the past decade after expenses. Compare this to the long-term Treasury bond yield of below 2.5% or the historic 7% return in the stock market. It's clear, why we're, hearing from institutional, from you, and why we hear from institutional investors looking to invest in private equity as part of their asset allocation strategy. And I think our job in the committee is to, of course, to make sure that we are punishing bad actors while not interfering with those that produce good returns. I don't know if you want to comment on that.
No, that's exactly the way I see this bill. Is the bill doesn't attack the private equity industry as it's being portrayed. The objective that I see, and I can't vouch for the validity and the outcome of every single provision, but the trajectory is to try to rein in and put some guidelines around how we operate to keep the bad actors under control.
Right, because you don't want to walk away. You don't want to be able to walk away from this investment tool.
We want the good actors to continue to receive our money and continue to grow our portfolios. And we want to do just like Walmart. Every year, we want to negotiate the costs so we can get them down.
Thank you. Thank you, sir. I yield back. Thank you, Madam Chairwoman.
Thank you. This side of the aisle have not vilified an entire industry, as was indicated by the previous speaker. The gentleman from Ohio, Mr. Stivers, is recognized for 5 minutes.
Thank you, Madam Chair. I appreciate you holding this hearing to illuminate a lot of issues in and around private equity. My first question is for Mr. Moore. Following up on the gentleman from New Jersey, I understand you're concerned about fees. Can you tell me, first of all, what your best performing class of investment was at your pension over the last 10 years?
I've said this 4 or 5 times. It's been private equity.
Oh, okay. Thank you. I appreciate you restating that. So does your pension fund calculate returns net of fees?
Yes.
What is the best performing class net of fees?
Yeah, that's what the performance.
Could you repeat it again? What's the best performing class net of fees?
Yeah, it's net of fees. That's the.
What is the best performing class?
Private equity.
Thank you.
Private equity is the best performing class net of fees.
Thank you. So that's really my first point. I have a million pensioners in Ohio that are part of the public retirement system, either OPERS or the school employees system or the police and fire system. That's teachers, policemen, firemen, public servants. They are getting in Ohio an annualized return over the last 10 years of about 13.3% from private equity, compared to about 7% from the stock market over the last same 10-year period. Just to put it in perspective, that's almost twice the return from the stock market. I understand your concern. That's why I ask about the return net of fees. That's really the point here, is even after the fees, the return is much, much greater. My next question is for Mr. Palmer. In your testimony, you talked about how small businesses who are seen as too risky for a lot of financial institutions now, have the post-crisis capital and liquidity rules made it more or less difficult for middle market companies, that Main Street companies, to obtain funding they need through banks?
In many cases, yes. I mean, the banks...
more difficult or less difficult
more
to get
difficult,
financing?
more difficult. Yes.
More difficult to get financing. So who typically fills that void today for middle market companies?
Private equity does.
So
private equity comes in and then sometimes enables the banks, but it's private equity is filling the gap.
I'd like to ask the whole panel if they've heard of any of these companies in my district. CCPI Blanchester, probably not. Plaskolite in Columbus, probably not. You might have heard of this one, the United Group in Lancaster, Ohio. Nope. And Rolling Hills Generating in Columbus, Ohio. These are mostly middle market companies. Oneida's the biggest one, used to be called Anchor Hocking. Anybody heard of Anchor Hocking Glass? Still no? Okay, well, they compete against China to make glassware all around this country. It's a tough market to compete in, and if it wasn't for private equity, thousands of employees at Anchor Hocking Glass would be out of a job, unemployed. They came in, they keep the company going, thousands of employees every day report to work, a lot of them union employees, and I'm glad private equity was there to do that. One last question, this one for Mr. Maloney. Do you think it is in the benefit of private equity, of a private equity firm to drive one of its portfolio companies out of business?
No, that's never the goal, and that's not a successful form of business.
And we did talk about, in the past, there have been a few business models, very bad examples, and by the way, there's good and bad in everything, of people who essentially raid and split up companies. You know, everybody thinks of the corporate raiders of the 80s. That was a long, long time ago. Is that a frequent business model today, Mr. Maloney?
No, sir, it's not.
And I've not seen that to be the case. And the small and medium-sized companies in my district have grown as a result of private equity. I'll tell you a story about a company called HFI that the owner was ready to do something else, but he had a growth opportunity and he wanted to continue to grow his company. He brought in private equity. They now employ 200 more people in Canal Winchester, Ohio than they did before. The company is thriving and doing well. It's an example of private equity at its best, and I know there are people who could point to bad examples, but there are a ton of great examples, and 26 million Americans are employed as a result of private equity investments, and I think we need to basically acknowledge that. I am the co-chair of the Middle Market Caucus, these middle market companies that dot this country and are in every congressional district in America, and private equity helps them. So I want to say, while there may be some more things that we can do, it's the best performing class net of fees, and it's helping grow jobs. I yield back.
The gentlewoman from Iowa, Ms. Axney, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you to the witnesses for being here. Appreciate it. We've spent a lot of time in this committee talking about affordable housing and the crisis that's hurting so many of our constituents across the country. One possible solution to the crunch in my district is manufactured housing, which can be more than 30% cheaper than traditional housing. Nationwide, almost 3 million manufactured homes are anchored in land-leased communities, which means that residents own the homes but lease the land underneath them. And many of these communities are being purchased by big outside investors and increasingly private equity firms. So I'd like to talk about how tenants are affected by increased private equity investment in land-leased communities. Dr. Appelbaum, would like to start with you. Why are these attractive investments for private equity firms?
Private equity is always looking for some place where it can jack up prices in order usually to pay off debt that it has put in place, not necessarily if these are smaller loans, but they're looking for a situation where people don't have a choice. It's the same story as it was in the emergency room doctors. You've already bought the manufactured house, you've already put it on this spot, you're a low-income person or you would not be living in this situation, generally speaking. The rent has been very affordable. This has been a good opportunity for people who are low income to have a decent standard of living. And then somebody comes along, a company, often private equity, not only private equity, buys up that the company that controls the land and then jacks up the rent. Why they do it, besides the fact that they make more money when they jack up the rent, there may be many different reasons for it. It may be that the actual physical real estate is valuable in the sense that if it had other kinds of businesses on it, for example, there would be a huge return. We've seen this, for example, with Hahnemann Hospital in Philadelphia. Private equity buys the hospital. It was already failing. It did nothing to turn it around. But the minute it bought it, it separated the real estate because it realized that that real estate, which was previously in a poor neighborhood but is now a gentrifying area, could be sold for other uses at much higher rates. So there are many motivations for these companies coming in and doing it. The jacking up of prices is usually to evict the tenants, to make them move someplace else and do something else with the land.
Thank you for that. So essentially, for these investors, it's a recession-proof revenue. They've got a captive investment, and they're going to capitalize on it at the expense of hardworking people. One trend we've seen in the market is when these communities are sold, rents can skyrocket. I saw how this happened firsthand to my constituents at Midwest Country Estates in Waukee. It's one of 5 manufactured housing communities that Haven Park Capital recently bought, and they're raising rents between 20% and 70%. So I want to reiterate that. Many of these people are on fixed incomes, and they're now being asked to pay 70% more in rent on a fixed income. And if they can't afford it, they've got very few options. As you implied, they can try to find a buyer. They can abandon all the equity that they've put into their home, or they can somehow come up with thousands of dollars miraculously that they couldn't find before. So rent increases like this not only hurt the tenants by raising costs, but they also decrease the value of the homes that they live in. Does this practice surprise you at all?
So I just want to be clear, we do have those many companies that are not behaving like this, but this is certainly one part of the business model, is to see about not how to make a business operate better, but how to maximize the returns that the private equity firm can get out of it. So here you have a situation that you've described where the owners are interested, the private equity firm owners are interested in their returns. They're not interested in whether this property can continue as a manufactured home property.
Appreciate that. So we all know that the homes in mobile home parks are truly not mobile, and that the residents are effectively a captive audience. What I'd like to reiterate here is that manufactured homes can be a solution for affordable housing, a great solution, but only if we can address the problem of outside investors buying up MHCs and raising rents to extract as much profit as they can from the people that live there. So we absolutely need to address that. We want to make sure that every person in this country has access to a nice roof over their head and that their children can grow up in a safe environment. So thank you so much for your testimony, and I yield back.
The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and many of my Democrat colleagues today have highlighted instances where private equity-backed companies have restructured the business model or cut jobs or filed for bankruptcy. And while it's true that successful buyouts may include cost-cutting, there are plenty of success stories that demonstrate how small businesses prosper through private investment and benefit from strategic insight that private funds can offer. Mr. Maloney, I was impressed with your testimony that private equity invested $685 billion in more than 4,700 businesses across the United States in 2018, and that 94% of PE investments are successful. One example of this success is Big Ass Fans, headquartered in my district in Lexington, Kentucky. As the colorful name suggests, this company makes, among other things, very large fans for commercial and residential facilities. This private equity-backed business has grown at an astounding annual rate of 30%. Since their private equity investment, Big Ass Fans has added nearly 200 jobs, developed and introduced new products, and increased their distribution channels. They have international offices in Australia, Canada, Malaysia, and Singapore, sell products in more than 170 countries, and employ over 700 people, 550 of whom work in my district in Kentucky. Their CEO, Lenny Rhodes, has told me that the stability provided by their private equity backers allows them to confidently make investments in their workforce, facilities, and technology because they have a partner with a shared goal of success. Big Ass Fans is innovating and pioneering the industry happily in the heart of central Kentucky and thriving no longer just as a fast-growing small company, but as the trusted producer on a global scale. This is a shining example right in my backyard of the direct impact private investment can have on job creation, technological innovation, and community development. Now, everyone here is sympathetic to Ms. De La Rosa's story and what happened to her. Everyone here is sympathetic to the other Toys R Us employees. And bankruptcies are unfortunate, and PE-backed companies are susceptible to market conditions just like other companies. But Mr. Maloney, the question is, what was a larger impact on Toys R Us's bankruptcy? Was it the private equity firms or was it the competitive pressures of Amazon?
Congressman, thank you for that question. And while I don't know the particulars, but what I can tell you is that at the time, you saw much different market forces. People were buying a lot more online. And, you know, as you know, there were other toy manufacturers and toy stores that went out of business. Some of them are backed by private equity. Some of them weren't backed by private equity.
Let me ask you the question this way. Did private equity forestall bankruptcy of Toys R Us, or did it cause it?
Well, during the time of private equity's ownership of Toys R Us, they actually expanded the number of stores. It's just unfortunate that it ended up this way, and that's largely because of market forces, as you say.
Well, again, kind of a follow-up on Mr. Stiver's question. Do private equity firms generally make more money investing in companies that go bankrupt or in companies that are successful?
We make more money for our investors when we are successful and we can exit.
Well, that makes a lot of sense because we see that at Big Ass Fans in Lexington, Kentucky. And I want to add that the private equity backers of Big Ass Fans is a firm that touts as one of its managers former Obama Treasury Secretary Jack Lew. And I'm just glad to see Democrats so actively involved in the provision of equity capital like Mr. Lew that has created very positive difference in Lexington, Kentucky. Glad to see that this is a bipartisan issue. Real quick on leverage lending. This hearing is obviously about private funds, and private credit deserves attention as well. Some of my Democrat colleagues have suggested that leverage lending is systemically risky. I've noted this before. It's important to make the distinction between credit risk, which is simply the cost of doing business in the credit economy, and systemic risk. In September, before this committee, SEC Chairman Clayton testified that he does not believe that leverage lending poses a systemic threat. Mr. Maloney, do you agree with the SEC Chairman that leverage lending does not pose a systemic risk to our economy?
Yes, Congressman, we agree with the regulators on that approach.
And final question, Mr. Palmer, can you elaborate on the stability that private funds can provide to the economy, especially in periods of distress?
Sure. I'll give you a real-world example. When the financial crisis happened, banks had to pull their loans on small businesses. Private equity funds stayed in them and kept those businesses alive. If you were backed by private equity, you were more likely to survive that downturn than if you had just had a normal bank loan.
Thanks. I yield back.
The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Yes. I am not hostile to private equity. We've seen private equity attacked for doing things that are done elsewhere in our economy. I think the gentlelady from Iowa is right. It's unconscionable to see these massive rent increases at mobile home parks. But I've seen that done by private owners, where you just have one owner. I've seen it done by traditional publicly owned corporations. We see private equity companies acting like capitalists, raising rents when they can, making money, not caring, and responsible to investors who are demanding an extra 0.1% rate of return, otherwise the money will shift elsewhere. So if they do care too much, they don't get any equity, equity investments. We've seen a lot of stores close. We've seen stores close for a lot of reasons. I'm not sure it's the private equity model. But if private equity is no different from or should be treated similarly as other major economic institutions, this raises the issue of whether we should get disclosures from private equity consistent to what we get from other ownership models. When we passed Dodd-Frank, we didn't demand that every public company give us a complete report on all their societal impacts, but we did require reports on conflict minerals, mine safety, and resource extraction. 3 areas that this committee decided were so important that corporate America should give us a report on it. A report released by the Trump administration critiqued these requirements, saying if the intent is to use the law to influence business conduct, then this effort will be undermined by imposing such requirements only on public companies and not on private companies. Dr. Appelbaum, should we require large companies owned through private equity to make the same kind of disclosures that we require of publicly held companies?
I think we should require them to make the same kinds of disclosures, and I think that they should be subject to the same kinds of regulation that other financial firms are subject to. We do not have this kind of risky behavior from mutual funds, for example, because they are subject to other kinds of regulation. The problem with leverage is not the use of leverage, it's the excessive use of leverage.
Yeah, well, I'm not even talking about leverage. You could make a completely non-leveraged purchase of a company that does perishable mine safety and has resource extraction agreements with third world countries that are ripe with corruption, and there could be no leverage involved. My focus here is on these disclosures, and I'll say as a shareholder, because all of us are in the pension plans, and I see Mr. Moore here representing so many of my constituents in the LA County plan. They know when you invest in a public company, their resource extraction rules. But when you invest in private equity, the ultimate owners, your pensioners, don't know, and they should. And I look forward to working with people here on legislation to require companies big enough to be public companies, companies with $50 million that happen to be private equity or privately owned, to make these disclosures that the Trump administration says is unfair to require only of public companies. Mr. Moore, we have the private equity companies not making some of the same disclosures to investors. That means you, that some would like. Would it make sense to form a union or association of pension plans and others to demand that the private equity firms provide you with information, particularly about fee and cost transparency?
Well, we do have the International Limited Partners Association that has been very vocal directly to the SEC and in support of this legislation on that very issue of disclosures. And the best disinfectant is always sunlight.
I would hope that in addition to lobbying us, that association would lobby you and say, don't invest in a public equity firm that doesn't give you the disclosures. I yield back.
The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Madam Chair. Appreciate the panel taking the time to be able to be here today. Mr. Palmer, I wanted to go back to a comment that you just made a little bit earlier in regards to PE being riskier investments. And ultimately, I'd like to know, is the goal to be able to lose money or is it to be able to make money?
Goal is to make money.
Goal is to make money. So you don't want to be able to force anybody into bankruptcy?
No.
So the goal is to be able to provide an actual return, to be able to get the businesses going, and to be able to create some real job security for those businesses?
Yes.
What is the best job security, really?
The best job security is a good business and for an employee to have options. If you have a strong economy, you can, one, have a business that you're staying in forever, or you can go someplace else because you have other choices. Right now, we have an incredibly low unemployment rate, and private equity funds have a real vested interest in keeping and maintaining and supporting their employees because getting new ones is hard.
Well, and I think that's an important point. You know, we're at record lows when it comes to unemployment in this country. We have more jobs available than there are people to be able to fill them. But the role that private equity can actually play is something that is of concern actually to me. I come from rural America. And we haven't really talked an awful lot about the makeup of the private equity industry. We know about the big private equity firms. The Carlyle Group has been mentioned. What's the real composition of that market right now?
Well, the composition of the market is, for the venture world, the early stage is overwhelmingly concentrated in Northern California, New York to Boston. Most of the smaller private equity is in the inverse of that. Rural areas face unique challenges with that. I was actually just with Congressman Hill last week in Arkansas talking about that. And we have a type of private equity fund called a Rural Business Investment Company that are fairly new, that we're trying to work with to help grow that part of the market because rural areas have far more challenging access to capital than pretty much anybody else.
You know, and for me, that's an important point. A lot of the focus of this committee, we get into the metropolitan areas, do not dispute the importance of that. But for rural America, when we're talking on a per capita basis, the impact of being able to have those businesses, and we actually have one that's in my district, a polymer company, that produces a very unique product. They have to be able to be innovative in terms of design, in terms of being able to market, ship worldwide, rely on some private equity dollars to be able to have that. But the access to those dollars in rural America out of the traditional financing sources is actually difficult. So that does actually play a real role in trying to be able to maintain those jobs and those economies in areas that are underserved. You know, I'd like to maybe follow up, Mr. Maloney, you may want to be able to speak to this as well. Is reasonable for companies like the polymer company that I just described, for them to be able to look to private equity to be able to meet their financial needs?
Absolutely, and that's what role we play, Congressman, in the marketplace is providing growth capital for companies like that to expand and grow their companies.
Yeah, I do want to follow up because some of the conversation today is obviously on H.R. 3848. When we're going to be adding new regulations coming into the place, all of a sudden we've got personal liability that you may actually be on the line. Is there going to, everyone understands, we're capitalists. We live in a free market. There are going to be good players, bad players. I think many of us would argue the majority overwhelmingly are people that are trying to be able to do the right thing. But if we add those new regs, is there actually some potential that we could be drying up some of those access to capital dollars, and particularly when we're talking about rural America?
Yes.
Mr. Maloney?
Absolutely, Congressman, and it's a real concern because there's a lot of businesses out there, as we talked about, in the mature space that need growth capital and need to be able to turn around. And if you impose liability, joint and several liability on the fund managers, no fund manager will ever take a risk and invest in any company again. They just won't do that. And that will leave a lot of businesses to fail much quicker than they will today.
Well, let's maybe explore, just kind of wrap up a bit here in terms of some of the bankruptcies. Would you maybe determine these were they mismanagement within the company? Was it the result that private equity had stepped in? Is it just market forces primarily?
I think it's a case-by-case basis. I mean, you have generally it's market forces, but sometimes it's international issues. It can be a flood could happen. There's innumerable reasons why things can go wrong, but it happens rarely.
Thanks, sir. I yield back.
The gentlewoman from California, Ms. Porter, is recognized for 5 minutes.
Thank you, Madam Chair. Dr. Appelbaum, you noted in your September 4th, 2019 study on private equity and surprise medical billing that we, the American people, and those that we are elected to serve, need to decide if the goal of health care is to increase profits or to improve patient outcomes. And hospital outsourcing of various departments has allowed physician practices to grow exponentially and operate those services independently. Once there used to be solo practitioner doctors and very small partnerships. But today, private equity firms have become major players, as you said, buying out doctors' practices and rolling them up into large corporate physician staffing firms. And we see it in a lot of different ways and creating a lot of different harms, and including in surprise billing. And I have personally been a victim of surprise billing and know how devastating it can be to receive one of those bills when you're trying to recover from an illness. Families today are also buried in medical debt. The new report from the Consumer Financial Protection Bureau shows that debt collectors pursuing medical debt is making a sharp increase. We know that about half of all bankruptcy reasons have a component of illness or injury and medical debt to them. One Stanford study found that the likelihood of receiving a surprise bill rose from 32% in 2010 to 43% in 2016. Do you think the involvement of private equity in physician contracts has increased the incidence of surprise billing?
Yes, absolutely, because what we've seen is that there are two really large doctor staffing firms It's not unusual for a hospital to say to a local doctor's practice, we'd like you to staff our emergency room. Those doctors come in, they're in network, the same network that the hospital is in. You go to the emergency room, you're treated by a doctor, taken care of by your insurance. In this situation, you have a very large company owned by private equity staffing the emergency room. Those doctors are not responsible for the billing. It's the overall company. And what they do is they take their doctors, either they take the doctors out of network, that's one company, and then they can charge you anything they want. If the doctor you see is out of network, you can be charged anything. You've done your due diligence, you're in a hospital that's in your network, you think the doctors will be there, you get that big bill. The other company uses the threat of surprise billing when it negotiates for in-network returns. And in both cases, what you see is that the doctors employed by these private equity-owned companies get payments that are way, way higher than the doctors who previously did the job or doctors in other hospitals not owned by private equity. So this is a major driver of healthcare costs. We have healthcare costs rising.
Yeah, and the same Stanford study found that the amount of surprise bills went up from $220 in 2010 to $628 in 2018. So it's both the incidence and the harm.
Yes.
I received an ad at my own home from a shadow group known as Physicians for Fair Coverage. And that group, backed by private equity firms, including KKR, Blackstone, Welsh, Carson, Anderson & Stowe, they spent more than $4.1 million lobbying against solutions to the problem of surprise billing. What would be the primary goal of those firms in trying to stop Congress from addressing surprise billing?
Of course, it's to protect their profits.
Thank you. So I have one last question.
Yeah.
Does the involvement of private equity in healthcare improve patient outcomes in any apparent way?
There's no evidence that it does, and there's some evidence that the quality of care goes down. The price evidence is very strong. The failure of quality is not quite as strong, but definitely we don't see improvement for the extra money we're paying.
Thank you so much. Mr. Maloney, if a private equity fund owns the equity, the debt, and credit default swaps, might that private equity firm, in some cases, have an incentive to force a company into bankruptcy?
I don't see a scenario, Congresswoman, where that would be beneficial to the...
Do you understand the concept of a credit default swap?
Well, I mean, most of our transactions don't involve the same private equity firm owning the debt and the equity.
Well, how will we know? Since credit default swaps are not, like they could own the debt, they'd have to disclose that on the bankruptcy petition, but if they bet the other way, that the company would go under by taking out a credit default swap, that very problem would be hidden from the bankruptcy court and the public, the employees, and all of those who are harmed by the bankruptcy.
I think that's a very unusual case, but thank you for that.
The gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Madam Chairman. I'm a small business owner, have been for 50 years. I'm a Main Street guy, and I believe the private equity industry is the epitome of capitalism. Large groups of investors pool their money together to look for businesses that can be restructured or infused with capital to expand product lines, hire more workers, and make a greater impact on communities in which they serve. Hundreds of thousands of jobs are being created through this country. Our schools' endowments are seeing huge returns, and innovative products are being brought to market because of this industry. For those people who fundamentally think capitalism is broken, private equity is an easy boogeyman to place blame when something goes wrong. The bottom line is you risk, you should get reward. So before I go on with my next question, I'd say, Mr. Maloney, you represent a sizable amount of people, and would you say that those folks are capitalists or socialists in your group? A quick answer.
Congressman, I would say that they're capitalists.
Are you a capitalist or socialist?
Congressman, I'm a capitalist.
Good. And Mr. Palmer, would you agree to the same situation with the people you represent yourself?
Unapologetic capitalists.
Okay. Well, you're a capitalist.
Heck yeah.
All right. So before I get, so I would just say this, where I come from in Texas, Private equity has invested almost $10 billion since 2013 and supports over 700,000 jobs. Not only have these investments pumped money into the Texas economy, they are necessary for the health of the pension system within the state. The Teachers' Retirement System of Texas, which has $154 billion in assets under their management, has $21 billion invested in private equity. Over the past decade, the annualized returns have been over 10%. We've heard that from many of you today on these investments to help support teachers' retirement throughout the state. Before we consider any drastic changes to such a large contributor to our economy, we need to take an extremely close look at the consequences that this would have across a variety of industries. So, Mr. Palmer, I know you've talked about this already before, but I think it bears repeating again. Can you talk about the effects that Stop Wall Street, the Looting Act, would have on various sectors of the economy should it become law?
It would be particularly damaging to the small private equity and medium-sized private equity economy. I showed a video, not a politicized video, but an actual video of the Senate sponsor of this bill explaining how private equity worked and what this bill would do to a room of 500 small business investors, and the air left the room. It would really be profoundly damaging, and the intent of the bill on the Senate side, not necessarily the House side, the intent on the Senate side seems awfully hostile. We want this industry to work, we want to create jobs, but it would be bad.
Okay. It seems like my friends on the other side of the aisle believe that there is a perverse incentive as a result of the structure of private equity investments. I would like to read a quote from the Houston Firefighters Relief and Retirement Fund Chairman Brett Besselman. He said this. He said, "We are very confident in the prospects for private equity investments in our long-term investment mix. Private equity opportunities far exceed those available in the stock market investing for the foreseeable future and are a welcome addition to our portfolio diversification effort." So if the incentives were off, I do not assume they would be receiving such high praise from the firefighters in Houston. So Mr. Maloney, can you explain how private equity funds are set up in regard to the general and limited partnerships, and give your thoughts on if you think the incentives of the two parties are properly aligned?
Yes, thank you for that question, Congressman. These investors are very aligned because the pension fund succeeds and gets a return when the private equity fund succeeds. And when that happens, everybody's a winner at the end of the day. And I would say that, you know, both of these contracts between the GP and the LP are carefully negotiated. The LPs get full transparency from the fund and can ask any questions from the GP that they want to, and we're very committed. They're very important partners for us, and we share as much information as possible with the LP. Thank you.
Okay, thank you. I yield my time back.
Thank you. The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you all for coming. I am here in no small part because of private equity. Freshman member of Congress, I spent 16 years as the CEO of a couple different companies. We put several $100 million of private equity to work. We built projects inside industrials that recovered energy they were wasting, recovered it, sold it back to them. They were really complicated projects, and I can say with complete confidence that there is no pocket of capital in the country that really maps to the investment size and the deal complexity of what we were doing. And I think I can expand that more broadly to the broader challenge we have to invest in our infrastructure, clean or otherwise. That there's just a deal size and a complexity that public markets aren't very well structured to do, ventures too small. And that's a positive thing. I'm also no longer in that company because of private equity, because the incentive structures within that private equity model, the 2 and 20 structure, the mid-teens return targets, create this massive pressure for a steady stream of liquidity events. And so having built a company and built a team that knew how to do something really important, I couldn't sustain it. Because once you have people with single-digit money out there, you sell down, and when you sell down to cheaper money, you sell down to money that's less risk tolerant. They don't build things. And I mention all that because one of my favorite descriptions, we had a limited partner who we were pitching a deal to once, and he said the central challenge we have with building infrastructure in this country is that we have a glacier of investment opportunities in the infrastructure, an ocean of investment opportunities in the infrastructure space that deliver really attractive dividend returns that is beautiful to this ocean, this glacier of money we have upstream, and we all hate the rivers. And I put that to you as a challenge. And so Mr. Maloney, I just want, and I don't, these are not gotcha questions, but I want to just run through a couple quick yes/nos to get to the meat of this. One of my investors described his industry, private equity, as custodians of wealth. Would you acknowledge that there is a tension between the financial goals of the owners of wealth and the financial incentives, sometimes, of the custodians of wealth?
I mean, I would say, Congressman, it's a very good point, but I would say most of the time the interests are aligned.
Okay. Do you agree that the mid-teens return targeted by private equity creates a very real incentive to take on debt and lever up equity returns?
Well, I think that they invest in these companies and try to deliver the mid-teen target for the pension funds and the retirees, as we've talked about. And, you know, I think you have to have a careful balance between how much debt you load on to grow the companies, and I think that they make those determinations on a case-by-case basis.
Would you agree that having mid-teens return targets creates a very real incentive to sell to people with cheaper money if the opportunity presents itself?
You know, I think it just depends on how you try to grow the company, and each case is separate.
Would you acknowledge that the sort of the traditional 2 and 20 structure or the variants thereof incentivize private equity managers to create liquidity events, either through debt raises or through sales?
Well, I think the liquidity event is meant for the investors, which are the pension funds and the college endowments. So at some point, you need to give your investors and the retirees the return, and I think that's what the motivation factor is.
Well, I guess I would put there back to what my LP said, that we had a wealthy family office, and he once said to me, he said, I know I'm smart, I know I'm really good, the last thing I want to do is to give my grandchildren an obligation to make an investment decision. They want yield. They don't necessarily want to have to reinvest. Would you agree that the carried interest deduction turbocharges the incentive to create liquidity events to the extent you can structure those liquidity events as capital gains?
Look, I think carried interest, the carried interest provision, it encourages the building of long-term capital and rewards and aligns the incentives between the LP and the GP.
Well, the reason I ask all those questions, and I get it, it's hard in a public forum like this to be totally forthcoming, but we have a massive need for investment in infrastructure in this country. And we can acknowledge that private equity is much better at that than a lot of other pockets of capital, but we have to acknowledge that it is still deeply flawed. And I want to work with you to try to figure out how to take away those flaws, but we have to first acknowledge, because I think every question that you said it depends, I disagree. I think those were all hard yeses. But we don't want to fix this by mandate. We
The
want to fix it
gentleman from
constructively.
Arkansas, Mr. Hill, is recognized for 5 minutes.
I thank the chair. Thank you for holding this hearing today. I appreciate the opportunity that you're showcasing Senator Warren's economic proposals. Perhaps after Thanksgiving, we can have a showcasing of Senator Sanders' economic proposals. Appreciate the opportunity to hear their impact on our economy. A couple of weeks ago in Arkansas, I had the pleasure of hosting a venture ecosystem summit. And Mr. Palmer, we appreciate you coming to Arkansas and graciously attending our event and talking about the current private funding market. It was very well received. Arkansas has a vibrant entrepreneurial community, and I wanted to bring together the stakeholders from across the state for a roundtable discussion to collaborate on ways we can foster the growth of our investing community, our entrepreneurial community, and craft better federal legislation that will push and help growing businesses onto that next stage of success. Mr. Palmer discussed some of the challenges associated with securing funding in states like Arkansas and potential ways to overcome those funding challenges. And much like his testimony today, he strongly advocated for the need for private equity and its investment in growing businesses all over the country, particularly off the East and West Coast. I agree completely. As an entrepreneur myself and now chair of the House Entrepreneurship Caucus, I want to emphasize how important it is to have a wide universe of funding options for new entrepreneurs to draw on. of companies of all sizes. This is Entrepreneurship Week across the country, so whether you're an angel investor or a venture capital fund or a private equity fund, all these forms of investment are important cogs in our nation's economy, and they impact all of our citizens. Just in my district in Arkansas, private equity has created over 1,600 jobs and invested more than $2 billion over the last 5 years. Pension funds, which touch a large portion of the American public, are clear examples of private equity beneficiaries. Now, Mr. Maloney, public pension funds are large, sophisticated investors, is that right?
Yes, sir, they are.
They're not mandated to invest in private equity, are they?
No, they're not.
And they have a lot of high-paid lawyers that work for them?
They do indeed.
And they do insist on measuring performance before they make an investment as a pension fund?
Yes, sir.
And would you say that pension funds are pushovers when it comes to negotiating with private equity funds?
I think they drive a hard bargain, yes.
Okay, so we've talked a lot about performance. So you would say pension funds are generally, they have benefited, and I appreciate Mr. Moore's repeated answers to those questions. I've got a chart I put up, which is public pension fund investment in private equity since 2000, and you can see it's grown from around 3% of assets under management up to about 8% of assets in that 20-year period. That's a pretty significant increase. So generally, I think the panel would agree that pension fund investors are pleased with their participation in private equity investing. And pension funds are so important to the working people of this country. Whether you're a retired city councilman in Boston or a retired law professor in California, you earn pensions, and we have such an underfunding problem. Anything that incrementally is better than the average return is so helpful to preserving those pension assets and retirement assets. And I think that's why CalPERS has argued we need private equity, we need more of it, and we need it now. All that to say that limiting private equity is not the answer. The majority has claimed today that private equity is bankrupting American companies and laying off thousands of American workers, and limiting private equity somehow can stop that. In my view, it will have the opposite effect. Limiting private equity will hinder business growth, constrain local employment, and hurt Main Street communities. We need to work to lower the cost to investment burdens, whether it's in a public forum or in a venture capital environment or an SBIC fund or private equity, and encourage more investment. And that's what I think we've done by lowering the corporate tax rate and bringing capital back to the country. We haven't talked about that today, that by encouraging capital to come back in the United States, some of those profits, now not double taxed, will flow into the investing community and through both angel investing and through firm investing. Mr. Palmer, you've looked at rural states like Arkansas. What do you think is the best thing that we can do to enhance investing in a rural state?
I think Arkansas is working on it right now, bringing together the universities, bringing together the financial leaders, the banks, the private equity funds that are there, and really trying to coordinate and get critical mass with the entrepreneurial ecosystem of incubators and others.
Thank you. I yield back.
Gentleman from Utah, Mr. McAdams, is recognized for 5 minutes.
Thank you, Chair Waters, for holding this hearing, and thank you to the witnesses for your testimony today. In a previous life, I was the mayor of Salt Lake County, and one of the areas where I was proud of our work was the ability to bring private sector resources to help address public sector problems. I often teamed up with many of the financial institutions in Utah to pursue innovative investments. For example, Salt Lake County pioneered many of the first pay-for-success or social impact bond programs in the nation. We expanded access to early childhood education, we targeted homelessness, and we reduced recidivism in our jails, and we couldn't have done these projects without financial partners. But I know that the desire to invest in projects that have more than a monetary return are not just limited to government problems. You see a range of investments in clean energy technologies and social welfare issues, for example. Our state, local, and federal governments and nonprofits don't always have the resources to solve problems by themselves, and I know that firsthand. Establishing a framework to use capital markets for problems isn't just harnessing capitalism for the greater good. I also believe it's smart public policy. Obviously, not every PE investment works out, and I don't agree with every decision or practice that PE funds make, and often employees of those companies that fail are unfortunately left behind. And we should clearly do better by employees who are laid off to ensure that they can re-enter the workforce, ensure that they have job training that they need to succeed, and also ensure a proper safety net. With that said, I'm interested in the trend for private equity firms to look at impact investing, or investments that incorporate environmental, social, and governance goals into the fund's investment strategy. So I guess my first question, Mr. Maloney, for many of your member companies, are you seeing a growing desire from either the fund managers or the limited partners when they make investments to incorporate social impact projects or ESG targets into the fund's investment strategies? And could you give maybe a couple of examples or maybe general trends?
Yes, Congressman, thank you for that question, and thank you for your leadership on that issue in Salt Lake. Many of our members are very interested in this. We are committed as an industry to responsible investing. AIC, our organization, adopted a set of comprehensive responsible investment guidelines that cover environmental, health, safety, labor, governance, and social issues, and we did that 10 years ago. And we have several of our funds that have specific social impact funds, and everyone sort of looks through a lens of ESG, and we are looking forward to working with you and coming in and speaking with you about how we can expand on that.
Great, thank you. And do funds report ESG metrics or on their investments to the limited partners?
Yes, and many limited partners are actually asking for that information now.
Right. And I'd be interested in exploring, maybe offline we can do this or later down the road, any legal or regulatory impediments to social impact investments or ESG investments that firms may see. In my state of Utah, several pension plans invest in private equity funds, as others have discussed. This comes in the form of a limited partner with a contractual agreement with the general partner who manages the fund. For instance, the Utah retirement system provides retirement benefits for more than 200,000 members in Utah, representing public sector employees. And I think at the end of 2018, URS investment portfolio was at roughly 12% in private equity, and the rate of return for 2018 in that private equity investment was at 18%, clearly higher than other asset classes that URS has investments in. And I know the board and officers of the retirement system take seriously their obligations to provide retirement security to all of its members. So, Mr. Maloney, in your members' conversations with limited partners, especially with retirement plans, why are they choosing investments in private equity versus other asset classes that they could be investing in? And has the share of private equity as a percentage of retirement system asset class changed over time? And any particular reason you could contribute to that?
Yes, Congressman. Great question. As we saw from the chart that was on the screen just a couple minutes ago, the asset allocation for private equity has almost tripled over the past 20 years. And I think the reason for that is it's an asset class that has proven to outperform other asset classes. And for a lot of pension funds that are underwater right now, they need that extra delivery and investment income.
Thank you. I thank the panel for their testimony, and I yield back.
The gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
Thank you, Madam Chair, and again, thank you to each of the witnesses for your time here today. So my colleague, Mr. Barr, touched on this earlier, and I think it's important to reiterate the point that during periods of economic downturn or strain, traditional financial institutions may pull back from providing commercial credit. So when that happens, it's private credit funds who step in to provide counter-cyclical support to businesses when they need it most. So this question is for you, Mr. Palmer, and also Mr. Maloney. Can you tell us how private funds support the commercial credit market during economic downturns when funding from traditional institutions may slow down?
Well, they can be more patient, and patience matters, particularly for smaller businesses that don't have access to public markets of just selling shares. And so they're in it for the long haul. They're in it for the long haul, and they sustain those businesses. North Carolina is uniquely positioned to have, for its size, having an extraordinary number of capital providers that do that type of capital, but not just in Charlotte, but also in Raleigh, in Greensboro, and now in Wilmington.
Thank you. Mr. Maloney?
Congressman, it's a great question, great point, and private equity is there to help these companies grow, and over 70% of the companies in America are not investment grade, so a lot of the times the banks won't lend to them, so they have to go to these private credit funds that can facilitate their ability to grow.
Thank you both. Ms. Appelbaum, appreciate your time here today. Yesterday, Senator Elizabeth Warren and Senator Bernie Sanders released a letter criticizing third-party research about the private equity industry. So, Ms. Appelbaum, do you produce third-party research about the private equity industry?
I'm not sure what you mean by third-party research. I go out and collect data. I interview private equity firms. And I report on what I have learned.
And it's research, right? And you're not
It's definitely
directly
research.
So. Okay, all right. So it sounds like third party. And does your organization accept donations from outside groups or from special interests?
No.
AARP, AFL-CIO, Open Society Foundation, just none of those.
We accept grants from foundations, so we may have.
Okay, so they're and those foundations typically have an interest.
We don't accept money from corporations, from government, from foreign interests, but we do accept money from individuals and from foundations.
Foundations, okay, understood. Can you tell this committee how your research on private equity was funded?
Yes, this is a very good question because I spent 4 years, Rose Batt and I spent 4 years on a $25,000 grant from the Russell Sage Foundation. It was a labor of love. When we got into it, we started out by saying, hey, we do a lot with labor. Teachers of labor economics don't understand what's going on. We should write something for them. And we had in mind a small pamphlet. And then as we got into it, we discovered it's a very complex subject and very interesting subject. And so we spent 4 years learning about it, writing about it, and producing a book that was a finalist for a very prestigious award from the Academy of Management. I think if you read the book, you'll find it's very balanced.
I mean, 25 Ks over 4 years. That's definitely a labor of love. So
it was
maybe
a labor of love.
Just wondering if any of these, do you think some of the other contributions help sort of offset that?
So we have unrestricted funds that we get at that time from the Ford Foundation, and that is, of course, somebody paid my salary with that. But the money it's very difficult, to tell you the truth, to get money for private equity research because usually we're interested in labor issues, and it's really hard. Eyes glaze over when you mention finance to people who care about labor issues.
Thank you. So again, another question. Senator Warren actually linked to your research in her official press release announcing her anti-private equity legislation, referring to it as the legislation's economic analysis. So I assume you're in communication and close coordination with Warren's team about this?
No, actually, they wrote the legislation. It turned out they had read my book. They asked me for a meeting because they had other questions. And then when I got there, they said, you're probably in a room with the only 4 people who have read your book cover to cover. So I think the book may have inspired the legislation. Afterwards, they asked me would I write a letter. I want to say the legislation is not anti-private equity. It's anti-excess leverage. And this is what the problem is. It is true that most of the private equity-owned companies do not end up in bankruptcy, but in the last recession, 27% of the bankruptcies were highly leveraged
Just in the
companies.
remaining few seconds, thank you so much. Was there any discussion or coordination with the Warren team during the report's development, timing of release, or preparation for this hearing?
For this hearing?
Yes.
No.
Thank you. I yield back.
The gentlewoman from North Carolina, Ms. Adams, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you for holding this hearing, and thank you to all of the individuals here to testify. Dr. Appelbaum, a recent report published by Ernst & Young celebrated private equity's role in the economy, noting that they employ 8.8 million workers, but another report found that private equity investments have led to a loss of 1.3 million jobs in the retail industry alone. So should we be concerned that so many workers are vulnerable to private equity strategies and efforts to maximize their profits, often at all costs, with little to no regard for the devastating impact that they can have on workers, consumers, and communities?
So publicly traded companies would never put 83 or 87 or any large amount of debt like that on the company. It's not that private equity firms want to drive companies into bankruptcy, but if they use excessive amounts of debt, then in fact, those companies are going to struggle. And in retail, where there are always changes going on, new fashions, new technology, and so on, publicly traded retail companies have low levels of debt so they can make the changes that they have to make. Private equity-owned companies do not, and that's why we see those particular failures.
Okay, so let's talk about a specific example that I find truly heartless and despicable. In 2018, Apollo Global Management funded the purchase of the Hahnemann University Hospital, a historic hospital that had been serving Philadelphia's poorest residents since 1848. That's 171 years in a community, providing a critical public good. And despite making no capital investments, the management company closed the hospital less than a year and a half later, claiming that it wasn't profitable. So the closure of the hospital left over 2,500 union workers without jobs, tens of thousands of Philadelphians without access to health care. Yet the company still stands to profit by selling off the hospital's assets and prime real estate. So can you explain how the owner of the hospital can profit by shuttering a hospital and eliminating a huge source of the city's health care services?
Yes, this was truly outrageous behavior. The private equity firm came in, bought the hospital with the idea that this is a possibility where you might want to improve things. The day that they bought the hospital, they separated the real estate and put it in a property company from the hospital, which was the operating company. And then I've studied healthcare as well. I won't go into details, but there are many things they could have done that would have helped turn that hospital around. They didn't lift a finger to do even one of those things. And so a hospital that was in trouble continued to be in trouble. 18 months later, they said, oh, well, the hospital is in trouble. We're going to declare bankruptcy. But the real estate was not included in the bankruptcy. The hospital has closed, but the private equity fund still owns the real estate.
So do communities or governments have any recourse when an institution like a hospital is shuttered by private equity?
They have no recourse after the fact, no. My recommendation going forward, because this is the first time this has happened, and it's going to be a model for cities with failing communities that have been poor, that are gentrifying. When a not-for-profit hospital becomes for-profit, the city and the state have a lot to say about what happens. They need to put in the charter that if this property is not used for health care, then the property reverts back to the community.
Thank you, ma'am. So, Mr. Maloney, as the head executive at the American Investment Council, you represent some of the largest private equity firms in the world. And given the profit maximizing model often employed by firms, do you believe that there's certain asset classes or investments that private equity firms should avoid, particularly industries related to public health that are incredibly sensitive in nature?
Congresswoman, thanks for your question, and thanks for your concern on these important health issues. I will say that we have a role to play, and a positive role to play, across the entire economy. Some of these hospitals and some of these medical facilities are private equity backed. Some of them aren't private equity backed, but they're still private. And I think we can have a positive role to play in that, and we would love to work with you and others on the committee to continue that positive role.
So, Mr. Moore, as you know, in California, public pensions are required to publicly disclose the fees and expenses paid to private equity funds. So why do you think this disclosure is necessary or helpful to investors?
So that we could do the proper analysis of costs that are being charged to us and compare them between different funds for different strategies and different potential outcomes. But that's only one part of the data that we need.
All right. Thank you very much. I yield back, Madam Chair.
Without objection, entering to the record the American Prospect article on private equity's latest scheme closing urban hospitals and selling off the real estate relative to Hahnemann University Hospital in Philadelphia. Without objection, such is the order. The gentleman from Ohio, Mr. Gonzalez, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to our panel here for your attention today. My fear as I look at the legislation and read some of the talking points is that we're looking at some of the worst examples that private equity has to offer. Toys R Us being one example. I don't think anybody involved in that deal would do it again if they had the opportunity. And we're taking a hatchet to an entire industry that supports millions of jobs as an important source of returns for many of our pensioners. Mr. Palmer, I'll start with you. I'm going to read a list of companies. Smile Direct Club, Slack, Beyond Meat, Uber, and Lyft. They've all gone public this year. What else do they have in common?
They're all backed by your private equity funds, I think.
Every single one of them.
Yeah.
Yeah. From start to finish, turns out. Mr. Palmer, who ultimately is invested in these funds? Like, who are the returns ultimately going to?
They're ultimately going to university endowments, pension funds, family offices, and individuals.
Teachers, firefighters,
Absolutely.
Police officers. Wonderful. And Mr. Moore, just because I think it's such a strong example, what is the highest returning asset class net of fees?
Let's see, I think this is a 7th time I had to
Just
say
again,
that.
I'd just like to hear it.
Okay. It's private equity.
Okay, wonderful. So to destroy the industry in its entirety would rob many of our pensioners of important returns. Not the intent, but it would certainly happen. So Mr. Palmer, I guess in your opinion, to follow up on that, would the Warren bill that we're talking about, would that result in more money in private equity funds or less, in your opinion?
Less, and particularly for smaller businesses, which are otherwise seen as risky.
So I want to talk about one specifically, which happens to be in my district, Highland Software. Have you heard of Highland?
I think I have, actually.
You have. They're an awesome business. They're owned by Thoma Bravo. Are you familiar with Thoma Bravo?
Yeah, they're the big guys.
Okay, so Thoma Bravo has owned the business for close to a decade, or maybe a little more than a decade. They provided liquidity to a founding family, have supported the growth of thousands of jobs. Thoma Bravo has been a great partner to Highland. When I talked to both folks at Thoma Bravo and folks at Highland, just an incredible story for our region. Northeast Ohio is a community where I'm from, where we need more private capital, frankly. We need as much private capital into our community as we can get. We need more businesses like a Highland Software. To grow in fast-growing, exciting industries and create jobs and opportunity for our community. And again, based on what you just said, I think the fear that I have, and I think everybody should have, when we look at this Warren bill, which I think would be a disaster for jobs and certainly for my community, is the effect that it would have in the real economy. I know research papers are nice and wonderful, but these have real implications for people on the street. And I am happy to see that the bill is not supported widely by my colleagues on the other side of the aisle. And I hope it dies here and in this committee. And with that, I yield back.
The gentleman from Illinois, Mr. Garcia, is recognized for 5 minutes.
Thank you, Madam Chair, and I'd like to thank all the panelists for joining us today. I'd like to begin noting Ms. De La Rosa's testimony, where you mentioned that you worked at Toys R Us for 20 years. When Toys R Us was bought by KKR and Bain in 2005, it was profitable. In fact, it had over $11 billion in sales the year before it was acquired. KKR and Bain's first order of business after they bought Toys R Us was to load it up with $5 billion in debt. By 2007, that interest consumed 97% of the company's operating profit. Dr. Appelbaum, what kind of effect would loading up Toys R Us with debt have on making the company more valuable and allowing it to be sold at a profit to its new owners?
So the purpose of loading it up with debt, and I agree with everyone who said that the goal is not to bankrupt the companies, but when you load a company up with debt and you sell it later, you make massive profit just off of the sale because you have so little equity there. But of course, debt is a two-edged sword. And if the company, you can sell the company, you make tons of money, but the private equity fund makes tons of money. But the company itself, which is responsible for repaying the debt, is at great risk, much greater risk of bankruptcy. I'm not saying they all go bankrupt, but the risk of bankruptcy definitely increases with this debt, and we saw in the Toys case what happened. They tried to go public. They didn't want to own it for all these years.
Got it.
They couldn't The public didn't want to buy it because they could see the debt. Publicly traded companies don't have debt at that level.
Okay. So to the affected, Ms. De La Rosa, you were at Toys R Us both before and after private equity's takeover. How did things start to change for you?
They immediately eliminated positions, full-time positions, management positions. All around, we switched operating companies that we used to manage the stores that were being in management. I was able to tell what the cost was, and switching company was, we were going to companies that were costing double what we did before. There was many different things that, would definitely cost a cut of hours, cut of positions.
So things changed for everyone, for you as a manager, for workers, and many people lost their jobs. That is precisely why I am supporting the Stop Wall Street Looting Act, because it seeks to rein in the excesses that have occurred and continue to occur in our economy, not because anyone is running for president, whether it's Senator Sanders or Warren. So to summarize, jobs were cut, hours were cut, and inventory was cut. For private equity, investing in Toys R Us really meant squeezing workers at every opportunity. Private equity squeezed so hard that the company collapsed, leaving workers and their families and whole communities to pick up the pieces. The retail apocalypse, mass bankruptcies and closures of legacy retail stores is often blamed on online shopping and technology, but that doesn't tell the full story. As we've heard today, private equity is playing a big role too. It is estimated that nearly 600,000 retail workers like Giovanna have lost their jobs at the hands of private equity over the last decade. I want to talk about another sector that has experienced significant disruption in recent years as well. Although technology gets blamed, private equity is forcing layoffs in the media as well. In 2007, things hit close to home for me when the media company, the Tribune Company, headquartered in Chicago, was saddled with over $13 billion in debt and driven into bankruptcy by what private equity investor Sam Zell called the deal from hell. More than 4,200 people lost jobs after that deal at newspapers and news stations around the country, including the Chicago Tribune and the Los Angeles Times, the Baltimore Sun, and more. Dr. Appelbaum, what kind of job losses usually follow when private equity takes over media companies?
Well, as you pointed out, I don't have the exact numbers on this, but there have been huge job losses. There has been huge consolidation. There has been less local news for people to be able to get. One of the big things that we see is not only are the jobs lost, but local people have no information about their local governments, the old beats that covered the things that were important to people so they could make decisions about their lives.
The gentleman's time has expired.
Thank you, and that's why we're advancing this legislation, to rein in the excesses. Thank you, Mr. Chairman. I yield back.
Thank you. The gentleman from Virginia, Mr. Riggleman, is recognized now for 5 minutes.
Thank you, Mr. Chairman, and thank you to all the witnesses here today. And I find this very interesting as we're talking about this, because we just had the mega bank witnesses not too long ago. We were talking about in that hearing when we're talking about really wanting to stop stock buybacks, effectively curbing investment returns, private sector growth. And one of the reasons I ran, I've been in for 11 months now, so I have a lot of experience, but one of the reasons that I ran for Congress specifically was government overreach into my own businesses, but also to my wife and daughters. And this is why I'm so interested in what's going on here. When we talk about private equity, we're not just talking about large companies, pension funds, things of that nature, and I know we've mentioned this multiple times, but I wouldn't be here without private equity. First, my Department of Defense business, I had a $90,000 investment from private equity. We were able to turn that into a 60-time multiplier on gross revenues, where we had 20 direct employees and 50 subs. Now my wife owns a chemical manufacturing plant of distilled spirits, but anyhow, so the issue we had with private equity then is we couldn't get a bank loan. Even though this is what she wanted to do, we put a lot of our own money into it, but we couldn't get the banks. They did not know how to evaluate anything when it came to COGS, when it came to overhead, when it came to labor salaries, based on the fact that we had to build specific types of inventory that they had no way to evaluate as we went forward. So as we're going forward in this, what I always fear is that the government is another member or a board member on my company or another company. What I also fear is when you see legislation this bad, which I call the Stop Entrepreneurship Act, when you see legislation this bad, I'm wondering if it's individuals writing this with good intentions, not understanding the law of unintended consequences or the cascading effects of this type of damaging thing. Let me ask a question. I'll start with Mr. Palmer, go to Mr. Maloney. I'm talking about asymmetric companies, and I'm talking about companies that maybe are non-traditional. For example, when you start a niche company, say in the Department of Defense and the intelligence community space, you're talking about maybe companies that have a very specific niche thing that they do. They can't get a loan to start. They can't even get a loan for office space. Do you know where they have to go? Your own money or private equity. If you're starting a manufacturing plant and you're one of the first 3 or 4 to do it the way that you're doing it, say in a whole state that doesn't understand it, you cannot get a loan. You have to go to private equity. Now, you have to have, as you know, pro formas. You have to know what pro formas are and P&Ls. You have to know all that kind of, all those things. But I think that's why the first thing I want to do before I get to the questions, I want to, and this is a third-party report, Mr. Chairman, I want to submit the economic impact analysis of the Stop Wall Street Looting Act. I ask unanimous consent to put that, to actually record this, please. So my question is this. When we're talking about private equity, we're talking about the things that drive the American economy. My question is, what happens to asymmetric or non-traditional businesses, Mr. Palmer, if this bill passes or something like this passes?
They'll have less access to capital. Private equity fills those gaps that don't fit neatly for a simple bank loan.
So, so Mr. Maloney, same question.
I agree with Brett that it will dry up capital needed for these asymmetrical businesses.
So in this report that I'm going to put in, it says there could result in a loss of 6.2 million to 26.3 million jobs across the United States. That's a projection. You know what that should say? 6.2 million and 31. Because it's the 31 jobs in our manufacturing facility that we wouldn't have right now. And it's the 70 total jobs and the multiple subcontracting companies that we had that would not be in business today. Now, I know it's not perfect. Trust me. I've dealt with private equity and venture firms. It's fantastic, and I would not recommend it to anyone. But anyhow, but I think what's amazing is that they were able to get us started, right? And they were able to do great things. And right now, if you talk about Charlottesville, Virginia, in my district, without them, without that angel network, I wouldn't have 31 employees. I wouldn't have, my wife wouldn't have locations in Virginia and Pennsylvania, and I would never have been able to even get to that point without private equity. I think as we go forward, and I had all these statistics that I wanted to throw out there, but I have 54 seconds, and if people knows about how fast I talk on data, we don't want to do that right now. This bill is not a law yet. And I think for me, as we're going forward, and some of the other questions I wanted to ask, and some of the things that blow my mind, if we actually, right now, if we were to do this, to actually create a loss of somewhere between $671 million to $3.36 billion per year, about half of which will be lost to pension fund retirees. I shudder to think that we're not going to go over this with a fine-tooth comb to make sure that we're not stopping the American economy in its tracks because we don't understand the law of unintended consequences, we don't understand cascading effects, and we don't understand the fact that government has no idea sometimes what it's doing in private business. That's all I have right now. Thank you, and I yield back my time.
Gentleman yields back. The gentleman from Florida, Mr. Lawson, is recognized for 5 minutes.
Thank you, Mr. Chairman. I would like to thank all y'all for coming to this committee today. It's one thing that's very interesting. We have some of you testifying that if this bill passed, what it's going to do to the private equity market, and then we have some that are speaking in terms of we need more transparency. I would like to say that the Florida government pension system is one of the largest in the country. It plays an important role in the lives of over 1 million workers. Private equity is often the best performing asset class for pensions. That is true in Florida. How can private equity funds such as Florida government pension system become more of a model for other private funds? And I will ask Mr. Moore that.
The question is, how could Florida
pension program become a model for other pension plans? Especially because a lot of them are having trouble all over the country.
Okay. I think I met your chief executive officer a few weeks ago, and he is a leader in the Council of Institutional Investors, and I think that is the forum that your pension fund can lead in bringing the whole thousands of pension funds in the country together to kind of look at policy prescriptions that would make everyone more successful in implementing their programs and follow the success that you've had.
When we speak of more transparency, Dr. Appelbaum, and that's what will be in this bill, which, you know, what is the difference between my colleagues here, Mr. Palmer and all of them says that this is going to cause a lot of problems in terms of investments that we need in private pension funds?
I think transparency is a problem for the private equity firms that do not wish to reveal, even to their limited partners, exactly what they're doing. It also makes it very difficult for anybody to do objective research. Unlike publicly traded funds where companies where you have a lot of information available, we do not have information available from the private equity firms about the performance of their funds. There's no publicly available database. There's no place that you can go. We do not have publicly available information about any actions that have been taken by a regulator against these firms. So they have an interest in being able to keep private as much as they want to keep private. That's why they're called private equity. It's in order that they can protect that privacy. And it is not to the advantage either of the pension funds that do the investing or to the general public that wants to understand what's happening in the economy or to be able to really evaluate the returns across all of the private equity firms and all of the pension funds. We don't have that kind of information. We really just have snapshots, and I really don't know what measure is used. The internal rate of return is a very poor measure of private equity performance. It's not used by finance professors anywhere to talk about private equity. We use the public market equivalent, and which is now published by PitchBook on a regular basis, but I don't hear that being used. And on that basis, at the median, the middle pension fund the private equity fund has not beaten the stock market since the financial crisis. They were great before that, not so great since, and it is true, there's a sliver. There's 10% of the pension funds invested in private equity funds that are getting really good returns. Half the private equity funds are not even matching the market. So good we have somebody here who represents a fund that does really well, but many, many pension funds are below water if you compare them with the public markets.
And I'm very aware of it because when I served in the Florida legislature, we looked at all of them across the country, and they really are. I don't have much time, but Mr. Palmer, did you care to comment?
Sure. The limited partners, these institutionals, they negotiate with the private equity fund before you start investing and before they decide whether they want to be in that fund or not. They get to choose what information they get or what they don't. So they can get that. So Mr. Moore can get at that, or other institutionals can get that. Particularly the smaller funds, they have to be very accommodating to pension funds and the information that they're looking for. The number of these large institutions have vast amounts of data on private equity and returns that may not be public, but that they have because they've done thousands of investments.
The gentleman's time has expired. I recognize myself for 5 minutes. We're not here to vilify an entire industry, but we're also not here to canonize them either. And listening to my colleagues on the other side of the aisle, seems like private equity has already been beatified and they're only waiting for sainthood. No, it's not the case. There are a lot of bad actors, and I think there's a lot more bad actors in private equity than there is in the public companies. And what happened to Toys R Us is, I think, a good example of one of those very bad actors in private equity. As has been noted up on the board here repeatedly, Toys R Us paid $470 million in fees and interest to private equity and wanted to give nothing, absolutely nothing, zero in severance to the workers. In fact, after the buyout, my understanding from the testimony of Ms. De La Rosa, and I read all your testimony, they got rid of holiday pay staff Christmas parties, birthday gifts, and some of the full-time positions started to get eliminated. Health benefits for part-time employees were taken away. And this was supposedly the new technology. Well, I have to say, and it's always stated that human capital is the most important asset a company has, then to act like this, certainly they didn't think that their human capital was the best asset that they had. Now, I have to say, I am familiar with that story. I hate to shop, I have to admit, but in 1998, my daughter was 2 years old, and I went to buy a present for her for Christmas, and it turns out that there was this beautiful kitchenette there. And I bought it. Turns out I couldn't fit it into my Toyota Supra, so I had to get help to tie it onto the roof. And one of the employees at Toys R Us came and helped me, tied it onto the roof. I drove it back. My daughter opened it up for Christmas, and I became a hero, of course. And that was Toys R Us. I enjoyed going to Toys R Us because of the service that I got there, and also the selection, so I didn't have to go anywhere else. But that seemed to change quite a bit, did it not, Ms. De La Rosa, once you had private equity come in?
Yes, it did, sir.
And how did it change in a negative way? Were people happy that they were there? I mean, were the employees more satisfied with their work?
Well, no, people were expected to do the jobs of 3 or 4 people. So productivity was increased, but yeah, for the half of the crew that was left with a job.
And I think that's one of the interesting things that a lot of the large companies, especially the banks, have been saying recently. That it's not just about the bottom line. It's also about the community. It's about the workers. It's about the nation. And I think that's one of the things we have to look at. And that's one of the things that private equity, unfortunately, I don't think does look at. It looks at simply the bottom line. And so that's why I think we do have to take a look at the law and how to change it. Now, my colleagues on the other side of the aisle say, well, we can't change the law at all because it's all about, letting the private sector do what it wants. Well, we change the law all the time. In fact, we have workers' compensation. We have workers' right. You can't discriminate against people based on a whole bunch of issues. So absolutely we can have laws that demand more transparency, disclosures, more fair, workers' rights. We can do this. In fact, I think a well-running system demands this. So again, I'm not here to vilify an entire industry because I do think that there are, in fact, opportunities and times when private equity is appropriate. I'm not here to vilify, but at the same time to say that somehow they're beatified, they're somehow saintly in what they do, that's absolutely not true. I think there's a whole lot of problems with them, and I think we have to deal with them. So again, I appreciate everyone that's here. I would add, though, at the end that one of the things that I think has to happen is that we have to take a look at what really is happening with the sense of who owns so much in the country. We talk about private equity and why do we have so few public companies and so many private? Because the money is going to the very few at the top. That's why. I mean, you talk about pension funds, yeah, but you didn't talk about the billionaires. And now we have people not only billionaires, 100 billionaires. A person has $100 million. Well, yeah, of course they can afford then to put it in private equity. And they're paying less and less in taxes, and that's not right. So that being said, I will yield back the rest of my time. And now the gentlewoman from Michigan, Mrs. Tlaib, you are recognized for 5 minutes.
Thank you, Mr. Chair, and thank you all so much for coming before our committee and giving us a better sense of why it's important for us to oversee some of the activities of private equity firms. There is a case that Michigan ACLU is working on that I want to talk to you all about. One of their clients, Devontae Ross. Devontae is a resident of Detroit who spent days behind bars because he couldn't afford to pay the $200 of bail related to a 5-year-old ticket for allegedly staying in a park after dark. He missed a job interview, and even more critical was an appointment with a government caseworker. His life was turned upside down. And this is a story of too many folks that live in poor communities who struggle with paying cash bail throughout my district. The largest bail bond company in the United States, Aladdin Bail Bonds, is owned by Endeavor Capital, a private equity firm that invests money on behalf of pension funds and endowments. Because Congress has yet to act to restricting private equity firms like Endeavor Capital, they continue to be still allowed to capitalize off of people behind bars simply because they're poor. So the question is for Mr. Moore, Trustee Moore, is it appropriate for private equity firms like Endeavor Capital to invest public employee retirement funds into predatory industries like bail bond industry to prey heavily on poor communities?
Well, I personally think no, and I would not vote for us to engage in any activities with that kind of firm. Our pension fund doesn't have any direct investments in any organizations that are involved in private prisons and that whole associated group of companies. Our only issue is that in the public markets where we are invested in index funds, the index includes everything, so we'd have to go in and ferret out and try to exclude those companies from our indexed and passive investments, but I would not support that at all.
You know, there is a growing bipartisan consensus throughout our country that incarcerating so many of our neighbors, our people in for-profit bail is a significant part of that problem. And the Washington Post last year highlighted private equity firms like Endeavor Capital's spending. They spent so much money opposing bail reform, noting that they're the largest funder of a campaign to roll back California's recently adopted bail reform law. And, you know, Ms. Appelbaum, you talked a little bit about this when it came to the healthcare industry. How much money does the private equity industry, like the cash bail industry, spend trying to keep government officials beholden to their interests?
Yeah, it'd be good if we had some public information about
That's
that.
right.
But just to set the record straight on the amount of money that was spent preventing the passage of bipartisan, really good bipartisan legislation in both the Senate and the House that would have reined in surprise medical bills, and that really had a good chance to pass, which is why they spent so much money. They first spent the $4.1 million that was mentioned to lobby for an amendment. They got the amendment. It didn't do them any good because the debt markets think that without being able to charge these high prices, they will not be able to make good on debt that is coming due in a couple of years. And their debt became distressed. And so now the last figure I saw was a $28 million campaign by Doctors and Patients United, which is actually Envision and Team Health, backed by KKR and Blackstone, to prevent any legislation from passing. And they've just stymied it for the moment. But these are bipartisan bills with a lot of support in both the House and the Senate. I think we're going to see them.
No, thank you. And Ms. De La Rosa, I just want you to know, I think there's a lot of my colleagues, especially this new class, that understands corporate greed is a disease in our country. And you can see it just alone with the behavior of private equity firms, even when we are trying to do the right thing, a bipartisan effort, even around incarceration in our country, around surprise billing in our country, trying to address the issues around healthcare. Corporate greed is tainting our democracy, and it's coming in a way that is pretty much hijacking any opportunity for regular folks like us to be able to have some sort of justice when it comes to issues that we feel like in very much ways is weighing heavily on communities like mine. I represent the third poorest congressional district in the country. You know, I come here, I represent 650,000 people, and I have to do this and try to push for legislation like disclosures and reporting. And what does it lead to? Going around the table, using all these under a coalition of folks and saying, you know, pushing kind of a misleading, gaslighting folks that it's not the right thing to do. So thank you all so much again for being here. I yield the rest of my time, Chairman. Thank you.
Thank you very much. The gentlewoman from New York, Ms. Ocasio-Cortez, is recognized now for 5 minutes.
Thank you, Mr. Chairman, and thank you all to all of our witnesses for coming here today. I have to admit that I am quite upset throughout this hearing because I feel like a lot of the initial questions that we're hearing almost betray the priorities that we've had as in our economy that have eroded people's quality of life. Because the first question that I hear from so many members are, how are the returns? But the returns are great, aren't they? How are the returns? And I wasn't sent here to safeguard and protect profit. I was sent here to safeguard and protect people. And we're talking about reining in private equity which is responsible for wiping out tens of thousands of jobs at Toys R Us alone. And then we're hearing, but what about the companies that made 100 jobs here or 200 jobs there? Toys R Us, 30,000 jobs wiped out. Shopko, 14,000 jobs. Brookstone, David's Bridal, Payless. Not to mention the impacts, the undemocratic impacts on media companies. Splinter, Deadspin, Sports Illustrated, local and regional newspapers. In the last 10 years, private equity is behind 597,000 lost jobs. And it's not just about the number of jobs. Isn't that right, Ms. De La Rosa? It's about the quality of jobs, right? When private equity took over Toys R Us, did you see folks' work schedules get cut back?
Yes, definitely.
Did you see people's benefits in some other ways cut back?
Yes.
Did your access to health care get damaged after private equity took over Toys R Us?
Yes, it was.
Did your mental health care was your mental health sacrificed as a result of how your quality of life was changed?
Very much.
Very much so. We need to think about our economy not just in terms of the returns for stockholders, but in terms of how the lives of workers are impacted. In May of this year, I sent a letter, along with Senator Warren, to Secretary Mnuchin regarding the Treasury Department's involvement in decisions related to the Sears bankruptcy. I want to take a step back and think about how some private equity companies on the other end take pension money on the front to acquire poorly rated indebted companies. Ms. Appelbaum, because of the high returns usually associated with private equity, pension funds invest the retirement funds of our teachers, firefighters, and civil servants in PE firms, correct?
They do, but the measure that they use, the metric for measuring success, is a very poor one. They use something called the internal rate of return. With more time, I can explain why this is an algorithm that does not really measure money you can take to the bank.
Right.
And so there's a lot of illusion creating here. They could report the public market equivalent, which would give us a lot more information.
Yes, and so we hear from a lot of folks saying, okay, we're using teachers' pension funds to buy into private equity. They're getting fabulous returns. This should be great, right? Can you explain to me why that may not be great?
Well, one of the things that we know, if we measure this appropriately, is that since the financial crisis, about half of the private equity funds have underperformed the stock market. Another quarter of them have barely beaten the stock market. CalPERS itself had to roll back its benchmark because it could not beat, it had a benchmark for its private equity returns. They are more risky, they should yield more return. They could not meet that more return, and they have cut their benchmark in half.
So private equity contains more risk than other parts of the market, correct?
Oh, absolutely, that's true. And the returns are good for the very top.
And would you say that more of these teachers and firefighters' pensions would you say that they're exposed to more risk or to more private equity now than they were, say, 10 years ago in the 2008 financial crisis?
Yes, they are.
They are. And if there's an economic downturn again, would they be exposed to more risk than they were before?
What I have not been able to say is that in the last economic downturn, 27% of highly leveraged firms went under. And what we know about private equity-owned companies is that they are highly leveraged. So saying that today there's no difference between publicly traded and private equity-owned companies is not really the issue. I agree with the regulators. Private equity, we're spending a lot of time on it here, is really small compared to the rest of the economy. So those leveraged loans are not going to bring down the whole economy, but trust me, there will be a lot of pain. Many companies employing workers that we all care about, important to communities that we all live in, are going to go under in the next recession.
Thank you. Thank you very much.
Thank you. Thank you very much. Without objection, I would like to add the following submissions to the committee for the record. Communication Workers of America, Private Equity Stakeholder Project, News Guild, Leo Hindering, co-chair of the Task Force on Jobs Creation, member of the Council on Foreign Relations, former CEO of AT&T Broadband, managing partner of media-based private equity fund Intermedia Partners, Institutional Limited Partners Association, David Halperin, Republic Report, CalSTRS, the Center for Popular Democracy, Truth Out, Americans for Financial Reform, Worth Rises, the Economic Policy Institute, Adam Levinton, Professor of Law, Georgetown University Law Center, Manufactured Housing Action. On behalf of the chair, Congressmember Waters, I'd like to thank our witnesses for their testimony here today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.